What's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market.
What I see from the data is certainly a loosening in the labor market.
I think the risk is that the unemployment may rise a little bit, not a lot, but a little bit from here.
We may be at a kind of inflection point in the labor market where you're actually going to see more weakness on the unemployment rate.
You can have two things be true. We have a good labor market, and it is weakening.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Things are going to look a little bit different this morning. Good morning from our New York City studio for our audience worldwide. This is Bloomberg Surveillance. The 4th of July holiday ends abruptly for Jobs Day in America with stocks at an all-time high. I'm Danny Berger, taking the reins with Manus Cranny this morning with John, Lisa, and Anne-Marie, probably out there on a beach somewhere enjoying the rest of the 4th of July holiday. For the rest of us, Manus, I think it should be made clear we did not draw the short straw this morning. We get the privilege of walking everyone not just to the weekend, but to Jobs Day. 190,000 is the estimate.
Yeah, and debating whether there's going to be a step down by a sitting president here in the United States of America, a regime change in the United Kingdom. And of course, what we're going to see here is whether we are really at some kind of tilt or an inflection point on this jobs report. As Mary Daly said, we are coming closer to that moment in time. And there's the data that we expect.
Yeah, the lowest estimate, Goldman Sachs, 140,000. But Manus, that is it. You hit the nail on the head. It is this idea of an inflection point. You can even kind of hear that in the language people are using to talk about this jobs day, about what they care about. Previously, we would have talked about wages, right? How hot are they going to come in? What does it mean for inflation? The language has now changed, though, that it's not necessarily about that. It's about the unemployment rate. Last jobs data, it surprised us by being 4%. 4.1%, Manus, is what we would need to trigger the SOM rule. So it's that deterioration. Is the labor market going to be more important for the Fed and force their hand to cut?
Well, suddenly the dual mandate will rise in its importance. And the three big alphas of the job gains over the past year have been healthcare, government, leisure and hospitality. And of course, a great deal of the immigration numbers have gone into shoring up those sectors, especially in leisure and hospitality. I think when it comes to the whisper number, we've got, 185 on the Bloomberg terminal at the moment. But I think, as you say, suddenly you're going to hear this tail risk, the really, really left tail risk that was recession that nobody has talked about. It's going to morph into a narrative, something around the soft landing. And this is something that we had discussed with our guests last week. What is a soft landing? And if it is a soft jobs number, services were low, what is that going to do to the momentum from the bond traders? Because they have been whiplashed like hell for the past 7 days.
And will it do anything to this equity market at all? That is a runaround train. 33 all-time highs on this equity market. Let me show you how things stack up heading into the jobs day today. We are looking at basically unchanged for S&P 500 futures, 0.01% higher. Euro versus the dollar weakness today with calm after UK politics. The 10-year yield, Manus, we are down 1.5 basis points. And this is what you were hitting on that I think is fascinating. The bond market has been captivated by politics. Post-debate, this idea of do we need to price in a Trump? The ISM data threw that into disarray. The weakest services ISM data that we have seen since the heart of the pandemic, that, hang on, maybe we need to back off on this trade. Perhaps yields should be lower. But with the uncertainty of this weekend of Joe Biden speaking to George Stephanopoulos on ABC, trying to really defend himself, I mean, it's anyone's guess where we land on Monday about what this political environment looks like.
He's got to do an awful lot in that interview to shift the narrative, because Trump is ahead in the polls. People are saying Kamala Harris should be handed the baton. She is a better proposition. But when it comes to these bond markets, it's as if you're right. We did this pivot from being politics that drove the burst steepening to the data which reinvigorated the bond bulls. And the question is as to what do the bond bulls need to see from this jobs data to take them through 425? We're in a bandwidth. We're in a classic trading bandwidth. 425 bid, 450 offer. What is it that breaks 425 with momentum? We've heard various people say pick up duration on this spike in yields. But don't forget that whiplash that they have felt from the burst steepeners last week is something today that we've probably got to be a little bit more cautious about.
Well, there's an asymmetric risk, Manus, because the high-frequency data has showed some of that softening. So I think this is a market that's prepared to see more softness. So what happens if we get another hot jobs print? But maybe the haven for us all today, as we are waking up here in the U.S., is the UK. Results as expected. Labour absolutely trounces Tories, which, let's be honest, is probably the most successful political party in the past 150 years, losing grip of their power in the UK.
not just losing grip, but essentially wiped, not completely off the political face. They're still going to be the main opposition. I think what is interesting in the numbers and the results is that there has been such a monumental swing by the general electorate to the right, to the Reform Party. Many people here will recognize Nigel Farage as being an ally of Donald Trump. And the momentum in terms of public votes that went to Reform, Labour have got the majority in the House of Commons, but it is wide and thin. I think that's the phrase that came through yesterday evening as the results came through.
And the reason I think this is so interesting is this idea of how big of a mandate do Labour have at this moment, if it is that thin majority. Rishi Sunak had been out campaigning before the results saying, don't hand them a blank check, essentially kind of tilting towards that Liz Truss idea that if you hand them a blank check, they could do something that upsets the bond market. But there is a clear check on them. Yeah. And it is this bond market. Nobody wants to be that prime minister that comes and is eventually kicked out because of the bond market. So they didn't even need this trouncing to be more, excuse the pun, conservative in their outlook for fiscal policy because they know what will happen. They don't want a repeat of Liz Truss.
They've been very, very clear about what their borrowing requirements will be. And there are fiscal rules in the United Kingdom that in some ways handcuff the Labour government, the incoming Labour government. What will they do with the fiscal framework? Will they change the fiscal framework and sell it to the gilt market as being we're going to borrow, but we're going to borrow for very, very focused investment? Howard Davies, the former chair of NatWest, was with Francine, and that was the point that he made. Labour have a target of 2.5% growth. That is just fantasy. According to the people that we've interviewed so far, 2.5% growth is something that's going to be difficult to attain. Sterling's on a run higher. The gilt market likes it. For now, the UK is a bastion, a mini haven in a European dislocated picture.
What a world. Who would have thought that we'd be talking about that?
What a time to be on surveillance.
We'd be talking about UK stability. Well, we're going to discuss that and more with our guests. Coming up, we have Peter Oppenheimer of Goldman Sachs with stocks rising and hitting new records across the globe. John Lieber of Eurasia Group as pressure mounts for President Biden to end his re-election bid. And Sarah House of Wells Fargo expecting a cooling U.S. labor market. We begin this morning with our top story. Global stocks trading at all-time highs ahead of the U.S. payrolls report due at 8:30 a.m. Eastern. A string of softer economic readings has been boosting bets for the Fed to start cutting rates in September. Peter Oppenheimer of Goldman Sachs joins us now. Peter, great to speak with you this morning. First of all, what are you expecting from this jobs data, and will it even matter for equity markets?
Yeah, firstly, look, our economists are forecasting 190,000, so that's below the consensus, and importantly, below the 3-month average that's been just under 250,000, and reflects this sort of cooling that you've been discussing. And I think it does matter. It matters because alongside some of the other macro data in the US, you're seeing more of a macro softening broadly. That's reflected in our own macro surprises index, which has turned negative. And of course, to some degree, that raises the expectations that rates can be cut earlier, and that's seen supportive of equities. But I don't think it's necessarily should be interpreted that way, because if the economy is weakening, that's going to raise concerns that earnings might be a little bit weaker moving forwards. And of course, as you say, equities are running hot at all-time highs, and indeed the market is extremely concentrated. So I think this data is going to be very important, very closely watched by the market.
Peter, you make an excellent point that the market will judge this as bad news is good news. But you're saying that, look, it's not necessarily good news. So if we do get weaker data coming in, what in this market looks mispriced? Because the gains have been led by the top, by NVIDIA, by the big tech stocks. So what needs to adjust to a softer economic environment?
Well, I think the points to emphasize here are just how concentrated the market has been. You know, the biggest 5 super large tech stocks have driven 60 or more % of the market gains in the S&P just this year. Huge differences in the returns. And of course, the valuations of those companies relative to the rest of the market. The rest of the market is reflecting more broadly the overall economic conditions. And, a softening is going to lessen expectations about what can be more broadly achieved. The hope would be, of course, that rate cuts would be forthcoming. We do think that that's going to happen and that inflation will moderate. But as you and Manis were discussing earlier, on top of this, there's a political dynamic and a focus on the deficit, which is rising, not just in the US, but many other places. And that's really putting some upward pressure on the longer end of the yield curve, which has a big impact, of course, on the cost of capital. So it's a bit more of a tricky mix moving forwards relative to what we've seen over the last 6-8 months. Remember, global equities from the October trough last year, as you started to get more optimism about rate cuts and soft landing, have gone up more than 30%. So from that base, I think things get a little bit trickier. We're looking at much flatter markets with more differentiation over the next few months.
Peter, good morning. So a little bit more differentiation, but then when I look at the top end of the market, as Danny says, Mag 7, 37% of the R&D will come from them, 23% of the free cash flow, 16% of the capex, and a $200 billion AI hyperscaler program to come. You've got dividends and buybacks. The differentiating theme in growth now is something different, fundamentally different, perhaps to what we've experienced in the past. Do you think it is time to still remain fully invested at the top end of the market, or is it time to lighten up a little bit? Given those kind of numbers going forward, it's going to be difficult to step back from major exposure to that Mag 7, isn't it?
It is, and these companies are phenomenally powerful for all the reasons that you said, and we've argued that they are not reflecting irrational exuberance and they're not in a bubble. The valuations in aggregate of these super large tech stocks are considerably lower than the equivalent largest companies in the tech bubble in the late 1990s or the Japanese bubble in the late 1980s. But nonetheless, EV to sales of the big 5 tech stocks have gone up to about 8 times compared to around 3 times for the rest of the market. And while these are fundamentally very, very strong, of course, with this degree of concentration, there is more risk in the market for any potential disappointments, particularly going into the second quarter. So the strategy that we've had really is more diversification across asset classes, across regions, and also across styles. So we've liked quality, strong balance sheet, high margin growth stocks, which include large tech and healthcare, for example. But alongside that, also looking at value parts of the market where you're actually seeing some very good compounding cash flow and dividend payments. So it's been an interesting year of mixes. You've seen super large US tech doing extremely well. And at the same time, you've seen, for example, European banks perform extremely well this year. These are really at the very opposite end of the growth value axis, a mix that we really haven't seen for a very long time. But I really think it speaks to greater differentiation and more diversification as being a crucial strategy that investors should follow.
Well, let's step into the dark side and talk about diversification into the UK. Obviously, it's a landslide. I think, as somebody said, it's Starmageddon in terms of the UK. Labour will take the mantle. The markets seem to be taking it very much in their stride. There's no shocks here at the moment. Sterling's on a roll. UK equities are higher. From the global flow of money, does the UK offer an alternative, a new and different alternative under Labour relative to, Peter, the past 8 years, let's say? There's imagery of Keir Starmer. Do you think the flow will materially change into the UK as a form of diversification, sir?
I do. Partly it reflects a good opportunity from a value perspective. You know, let's be clear, the UK index, the FTSE 100, which doesn't have any large cap tech in it, and for that reason, partly has been a structural underperformer, has a good mix of highly cash generative value sectors, banks, healthcare, miners and resources, energy, for example, sectors that we like. The free cash flow yield being generated in the UK market is over 6%, pretty much the highest in the world. And the PE is around 11.5 times, half what it is in the US, and these companies are paying dividends. So from a valuation perspective, it looks really quite interesting. But in addition to that, the political outcome here is extraordinarily powerful mandate, because you have a very large majority in a government that has preset its fiscal rules, as you said, Manus, and therefore there isn't the same sort of concern about a significant shock in the bond market. And of course, that big majority and therefore the prospect of a stable, relatively centrist economic fiscal mandate looks very unusual at the moment in the world that we're in, given what's happening in other countries. And that, in addition to the valuation attraction, I think is bringing down the risk premium. And we're seeing some inflows coming in and certainly a lot more interest in UK assets.
Peter, we'll spare you of having to talk about U.S. politics. Peter Oppenheimer of Goldman Sachs, thanks for joining. Enjoy your weekend. UK stocks up 0.25% this morning. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakez. Hi, Yahira.
Hi, Danny. Hamas broadly agreeing to the framework of a ceasefire proposal with Israel, according to a senior U.S. official. That framework may provide the basis for an agreement that would lead to the release of sick, wounded female and older male hostages from Gaza. Israel is sending negotiators to Qatar to try and finalize an agreement, with U.S. officials also set to take part. The progress coming as Israel weathered a rocket attack from Hezbollah militants across the Lebanese border, raising fears of a full-blown regional conflict. Hurricane Beryl is approaching Mexico's Yucatan Peninsula. Storm warnings are in effect along the Mayan Riviera, with alerts stretching from Costa Maya port to Cancun. Beryl has already left a trail of destruction through the Caribbean. It was the earliest Atlantic storm to reach Category 5 strength, signaling an early start and likely an active hurricane season as hot ocean waters fuel tropical systems. That's your Bloomberg Brief. Danny?
Yahira, thank you so much. Up next, Biden not backing down.
The president was very clear that he is in this to win this. And the president is our nominee. The president is our party leader. And the president has told us, and he was very clear back there, that he is in this to win this.
That's coming up next on the program. You're watching Bloomberg Surveillance. Morning on this Friday, dominated by politics and eco data. Under surveillance this morning, Biden not backing down.
We are all looking for the path to win. A path to victory in November is the number one priority, and that's the number one priority of the president.
We will stand with the president because we fight that force being Donald Trump, and I felt very confident coming out of this meeting.
The president was very clear that he is in this to win this, and the president is our nominee. The president is our party leader, and the president has told us, and he was very clear back there, that he is in this to win this.
Here's the latest. Top Democratic governors rallying behind President Joe Biden ahead of his interview tonight on ABC with George Stephanopoulos. This is the president's first major interview since last week's poor debate performance, with the calls growing for Biden to end his re-election campaign. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, what is the Team Biden strategy at this point to regain the trust of Americans who watched that debate performance?
Yeah, hey, Danny. Well, new this morning, the Biden campaign is outlining how it plans to reach out to battleground state voters for the month of July. This includes a nearly $50 million media blitz, where the campaign says that they're going to do some strategic investment when it comes to ad buys in key states during some key events like the Olympics later this month, and even the RNC, the Republican National Convention, which is slated to kick off in just over a week. Now, the campaign also went on to describe what they're calling an aggressive in-person campaign schedule over the next month for President Biden and Vice President Kamala Harris. That kicks off tonight as he heads to Madison, Wisconsin, before that interview with ABC News that you mentioned that we're expecting to air later this evening. He's then going to head to Philadelphia over the weekend. Of course, both of these two critical battleground states. And as you alluded to, all of these appearances are going to be highly, highly scrutinized, both on the campaign trail and also here in Washington, particularly as President Biden gets ready to welcome nearly 32 NATO member countries to Washington, D.C. this week as the annual NATO summit kicks off. We are expecting him to hold a press conference later next week where he will no doubt face questions about his viability as a candidate.
Tyler, thanks. A busy weekend and weeks to come. Tyler Kendall there in D.C. John Lieber of Eurasia Group writing this, that President Joe Biden's inability to tame the story about his cognitive decline has prompted Eurasia Group to increase the odds that he will exit the race from 15% to 25%. John joins us now. John, good morning to you. You heard it there from Tyler, the strategy of Team Biden. Get him out there as much as you can. Put him in front of different interviews with ABC. Later tonight, we'll hear that. Have him do Q&As. Give him a grueling schedule. Is it enough?
Yeah, I'm concerned that 25% odds might be low. I mean, Biden has not looked good for a while in public appearances. The debate was just one of many reports we're hearing about what happens behind the scenes at the G7 meeting, a meeting with congressional leaders. There's just a lot of signs that he's losing a step or three. And his appearance yesterday at the 4th of July at the White House was fine, was competent, but didn't seem like a politician that was exactly at the top of his game. And the stakes of this interview tonight are going to be incredibly high for Biden. But even if he gets through this, he's got to go through another 3 or 4 months of campaigning where he's got to be out there publicly making the case that he's vigorous enough to last another 4 years. And if he doesn't, he's going to be in big trouble and probably hand the election back over to former President Trump.
John, good morning. What is the smart, political, graceful way out of this? Is this fill or kill weekend in terms of going head-to-head with Trump? There are the polls, 48% to Trump, 42% to Biden. Is the smart, graceful way right now to try and find a graceful exit? Because he doesn't sound like a president that's ready to do that. No one's pushing me out.
Well, every day he doesn't exit the race, the anger, if and when he eventually does, at him is going to be higher and higher and higher. So he should move quickly to preserve his legacy if he's going to step aside. And, it's possible he blows us away tonight, the way he blew everyone away at the State of the Union, making this question go away, at least until the next incident happens. But if he does drop out, he's going to have to do it soon. The Democrats, they're almost certainly going to replace him with Kamala Harris, the vice president. If he does step aside, that can really happen at any moment between now and Election Day. But the momentum loss they're going to face from him staying in here, not exactly thrilling the voters, is going to be massive. So the earlier he does this, the better off he is and his legacy is.
In many ways, if he does choose to go, or if he's forced to go, or if he's advised to go by his family, as you say, you think it's the family and the inner court of Biden that will drive him to make this decision to exit rather than the Democratic Party. How much of a poison chalice is it for anybody else who takes it, apart from Kamala Harris? She gets the money. She gets the money transfer. She can get the black vote out, the female vote out. She is strong. She's strong, polling strongly. She is the obvious candidate because everybody else, this is a poison chalice.
Yeah, I think that's right. I mean, I don't think you're better off picking somebody with lower name recognition than Harris, who has not been tested on the campaign trail. So for somebody like Gretchen Whitmer, who's got a really promising political career in front of her, or Gavin Newsom, who, this would have been his moment to run in a normal cycle where Biden decided to drop out earlier. These people have long political careers ahead of them. Losing to Donald Trump in 2024, not exactly a way to set that up. And they probably start off at a disadvantage because no one knows who they are. Whereas Harris can kind of step into the race. She can sort of mop up the mess, clean up on aisle Biden, get through. Whether or not she wins, and she wins, that's fantastic. If she loses, you can't really blame her. She did what she had to do. She can always come back in 2028. So I think for just thinking about the personal incentives of any of these people, Harris has the least to lose from being the nominee.
John, we have only a minute here. But the strategy from Donald Trump has been stay quiet, relatively quiet, and let the Democratic Party implode. If Biden steps down and someone else takes the reign, can Trump still afford to do that? Can he make this a referendum on a chaotic Democratic Party?
Yeah, absolutely. I think Trump's been running a very disciplined campaign so far. He hasn't really been drawing attention to himself the way he would have in, say, 2016. And he's let Biden be the main character of the election, which is exactly what he needs to do to win. If Harris comes in, he's going to have to quickly define her in the eyes of the American people as too progressive, as a party to all the inflation they've been experiencing, and basically Biden part two. I don't think that's going to be terribly hard for him, but you'd expect to be him out there more vigorously trying to define her in that situation.
John, appreciate it. Enjoy your weekend. John Lieber of Eurasia Group. Okay, coming up, the latest from London as Labour emerges with a landslide victory in the UK. What sort of fiscal agenda will they present to the public? Are the risks over? We'll discuss here on Bloomberg Surveillance. Two hours until your jobs data hits the tape. At the meantime, equities trading again at all-time highs, only a little bit higher. But if we do that, we're going to be at our 34th record for the year. Meanwhile, NASDAQ 100 futures, it's the same old story. Tech takes the reins. while Russell 2000 futures fall by 0.2%. Let's flip up the board. Look at this bond market. Bonds under pressure. They were under pressure after the politics, and then they get a bid thanks to ISM data. It is a whipsawing market, down about 2 basis points across the curve, save for the 30-year, down 1.5. Under surveillance this morning, pressure mounting on President Joe Biden to end his re-election bid. A growing number of donors saying that they will not back the campaign unless Biden bows out. Disney heir Abigail Disney joined Netflix co-founder Reed Hastings, who is also calling for a change on the Democratic ticket. And man, it's not just some of these Democratic donors. It is Congress people themselves. Yet another House Democrat came out against Biden as nominee, Seth Moulton of Massachusetts, saying when your strategy isn't working, it's rarely the right decision to double down. President Biden is not going to get younger.
No, I mean, there are some very, very obvious facts about his acuity at the moment. He's got this interview this evening on ABC. Can he do something to materially change the narrative, engage with the ABC presenter, George Stephanopoulos? I think what you have here, we've just had a conversation with Eurasia, and they say the probability, 25% probability of him stepping down, actually looks low in terms of who will drive that narrative, this fill or kill weekend, which some people are saying we are in terms of remaining in the race. That will be by an inner circle. That will be by Biden's family. That will be by the real inner advisors. And interestingly, not necessarily the Democrat cohorts who may sign a letter asking for him to step down.
The thing is the Biden campaign has really been focusing on his mental acuity, saying we can prove that this was a one-off. But The Economist is running with a front page over the weekend saying that it is not the issue of his mental acuity. Instead, it is the operation by his campaign to deny what tens of millions of Americans saw. That essentially it is a bell that can't be unrung, because the problem is not his mental acuity. Again, it's a problem that the campaign essentially lied to the American people, saying, yes, you might have seen him stumbling, but that is not President Biden. And that is what they lay out as the real error. And how can you fix that? Just by having a good interview or going out on the campaign stump a lot?
Well, again, the Trump campaign has been, and even if obviously the previous debate was very, very obvious. There were rules and regulations in terms of interjection, but Trump comes out and asks again for a head-to-head, no holes barred, one-to-one again, mounting the pressure that that's the forum that they want to try and challenge Biden to step into again. And that is everything that the Democrats do not want. They do not want an open-ended, no-holes-barred discussion for Biden to step into.
Well, before we can get to that, Manis, we have to get to the economic data. Under surveillance, the U.S. labor market is expected to show more signs of cooling, with the June payrolls report due in about 2 hours. The median estimate in Bloomberg's survey expects 190,000 jobs added for the month of June. That is a drop from the 272,000 added in May. Manis, it is a step down, but let's be honest, the concentration is on the unemployment figure. At 4%, that was the real rub in last month's. 4.1%, if we get there, would trigger the SOM rule.
Yeah, and this march higher in unemployment suddenly raises the dual mandate. And again, you've heard this. Powell talked about the jobs narrative when he was in Portugal a little bit earlier this week at Sintra, the gathering with all of the central bankers. Mary Daly talks about a tipping point or that inflection point in the jobs market. But what level of unemployment? So this is then you extrapolate forward. What level of unemployment do you need to see before the end of the year to invoke 2 rate cuts? And it is the jobs report which is going to drive more than the inflation report on the scenario for cuts.
I think that language that you're talking about from Powell, from Daly, gets even more interesting with the hindsight of the Fed's minutes. We got those out before we all, went to go see the fireworks. And they made it clear that the bar to cut is really high. Some of them talking about even raising rates. Yet again, they even talked about the politics, the fear of that. But let's keep in mind that June meeting was at a time when the Atlanta Fed nowcast was something like 3.1%. GDP now, tracked by them, is 1.5%. The Doves aren't saying, Manis, that they are ready to cut, but they are getting louder and they're getting more bold. So what happens when you have a weak jobs data in hand is, a lot of people expect we will.
I think what it'll do is it'll reinvigorate, the bond bulls who almost were off the leash and running, and then they got this politics. Look, data trumped politics in the first 3 days of this week, and you suddenly saw not a capitulation, but a shift from Burr Steepners, which was a rise in the long end, to suddenly going, wow, services, the biggest drop in 4 years. Suddenly the narrative shifts to a slowdown, a soft slowdown, rather than just a soft landing.
Soft slowdown. Soft, but not softer. I need to get these things right. Soft cube. Okay, writing it down in my notes. Meanwhile, Keir Starmer is set to become the next UK Prime Minister after Labour's landslide election victory. The results bring an end to 14 years of Conservative rule as Labour clinches a majority in Parliament. Starmer is expected to speak in just under an hour from 10 Downing, and that's where Bloomberg's Tom McKenzie is now. Tom, great to speak to you this morning. It has been a busy 24 hours for you. Tell us what sort of mandate that Labour now has in their hand to rule.
You talk about the landslide victory. That is absolutely what we now have for this incoming Labour government. What we do not have is the super majority that many of the polls had actually predicted. It was the best result, yes, for this Labour Party since Tony Blair in 1997, but it did not best Blair, who came in with 418 seats. It looks like this Labour government's going to have 411, 412 or thereabouts, give or take. There's a few more seats to come through. They do, of course, have a significant mandate on the back of this, and it is a marked turnaround from those events of 2019 when, in fact, the Labour Party had their worst electoral outcome since the 1930s. But on some levels, this is a rather thin consensus that's come through in terms of the majority for this Labour Party. And they're constrained as well by the fiscal constraints that face this country. Growth expectations are below 1%. We know that debt to GDP is closing in 100%. The first 100 days, of course, are going to be crucial. So watching for that. The future Prime Minister, Keir Starmer, the incoming Prime Minister, will be speaking, as you said, behind me, 10 Downing Street, in about 30 minutes' time. Rishi Sunak left about an hour ago for the last time, 10 Downing Street, and said that he has respect for Keir Starmer. He also apologised to his team.
Well, there's not much time for British politicians between victory and the hell that is exit in politics. They go in the space of 24 hours, out the door with your bags. One thing for certain, though, Tom, is global markets. We're sitting in New York at 6:36 a.m. in New York. It is the 5th of July. Here we are, the flow of money. Right now, sterling looks healthy. The gilt market has not convulsed aka the moment of Liz Truss's policy under the Tories. What is it in this honeymoon period that Starmer must convey to markets to deliver a flow of capital and upscale the flow of capital to the United Kingdom?
Starmer and his incoming Chancellor of the Exchequer, Rachel Reeves, have emphasised time and time again that growth is their priority. Starmer put out there he wants to get back to growth of 2.5%, the kind of growth we saw under the Blair years. For many, that seems a stretch, to say the least. So look for them to reiterate that view, particularly when he comes out with this speech in about 30 minutes' time. But make no mistake, this is an interventionist manifesto from this Labour Party. They want to create a British energy company. They want to rip up planning rules to allow more building of homes. That is going to be a priority in the next 100 days. They're going to be focused on renewables. They're going to be spending a little bit more around the edges. They're not going to be overspending. That's the commitment they've made, given where we are in terms of the debt to GDP and the deficit levels. But he will need to come out with that reassurance. So far, the pound is up 7 straight days. The markets are reassured. Jeffrey's putting out a note, though, saying that there is stability now with this majority for Labour. Longer term, though, Jeffrey's pointing out that potentially there's a risk, given that underneath the surface you've seen big gains for the right-wing Reform Party, the Green Party as well, and the Liberal Democrats. The rewiring of the electoral system here in the UK could pose risks further down the line.
And this is the big risk to Starmageddon, is that it could be one term and done. He's got to bring the country with him. He's got a wide but thin majority, and there is a rise to the right. Nigel Farage, for our viewers, is a confidant, close to Donald Trump. It really was a shift in the mandate from the British people, not necessarily to Labour, but away from Labour and onto the right.
Absolutely, Manus. This is an awkward coalition in many ways for Keir Starmer, because he's taken seats in the south, he's retaken seats in the north of the country, constituents who have very different demands of him. And you point out Nigel Farage, it was a very big win for him and the Reform UK party. Let's not forget, Labour came in and took 34%, just 34% of total votes. And the gains coming through Reform, the gains coming through the Green Party, and a very big night as well for the Liberal Democrats. Now, to Farage, he came out and said, we are targeting Labour next. And I think that is really consequential. What is also consequential is how the Conservative Party reforms. Rishi Sunak says he will remain leader until there is a transition. You can imagine the horse trading around who's going to take over from this diminished Conservative Party is already underway. But what kind of Conservative Party do we get on the back of this? Is it a centrist one, or does it move to the right? Does it absorb Reform UK? Is there a coalition between those two parties? That is something to watch going forward. This is a majority and a sweep for the Labour Party, but it is built on thin foundations.
Tom, I know you're getting rained on, so I'll make this one quick. But for this market, looking at the results today, is there forever a check on the Prime Minister living with the ghost of Liz Truss and the blow-up of the gilt market?
That has to remain, doesn't it, particularly in this environment. Look, Bank of America says fund flows are coming back into UK assets. We've seen that stability, the upside coming through for the pound. The BOE could come through with a cut in August. That would be a nice fillip, wouldn't it? A nice upside surprise, a gift maybe for Keir Starmer when he takes over, and as he remains, of course, and he moves into 10 Downing Street behind me. But yes, look, there will be embedded in the UK asset story is the shock that came through from Liz Truss, who, by the way, lost her seat as well. And the marked move that we saw in the gilt markets, that will constrain the politics of this new government. The fiscal wriggle room for them is narrow. The markets for now are taking reassurance from the fact that this is a Labour Party that has taken the lessons from Liz Truss and will ensure that it's constrained in terms of its budget. We look ahead then to the first 100 days, but then to the autumn statement. Could be September, possibly October, from the Chancellor Rachel Reeves. The investors I've been speaking to so far this morning saying that for them is key. Will she match the rhetoric leading up to this vote with reality when it comes to the autumn statement towards the end of this year?
Well, Tom, we don't want you pulling a Rishi Sunak getting drenched outside of 10 Downing Street, so we will let you go. Stay dry. Bloomberg's Tom McKenzie. And Manus, you know, talking there about sort of the more conservative approach, not conservative big C, but small c, from the Labour government, I can't help but wonder if not, is some of the downside priced in, but is some of that upside priced in? A government that maybe doesn't move away from Brexit, but is more friendly towards trading partners. Is there an element of that we have yet to appreciate? So from here on out, it could be an upward surprise.
Well, I think we've just had that conversation with Peter Oppenheimer from Goldman Sachs, and he talks about, you know, a little bit more dependability, a little bit more surety in terms of what the plans are. Labour have been pretty clear about what their fiscal agenda is and how they intend to get there. And as Howard Davies, the former chair of NatWest, said a little bit earlier in programming, this is about selling to the gilt market that you are borrowing. You are borrowing for investment, not for profligacy. And in that context, the gilt market may not convulse in the same way as Liz Truss was selling a version of fiscal largesse for growth. That convulsed. This is a different version, but growth of 2.5% is somewhat of a fantasy.
What do UBS call it? The island of stability?
The island of stability.
The island of stability. I love that. Okay.
I mean, no longer the basket case post-Brexit. There you go.
Who would have thought? All right, let's get you an update on stories elsewhere this morning. With that, and your Bloomberg brief is Yahira Haquez. Hi, Yahira.
Hi, Danny. The owner of Saks Fifth Avenue is acquiring Neiman Marcus Group for $2.65 billion in a deal that will unite America's two largest high-end department store chains. Amazon and Salesforce will help facilitate the deal by Saks owner Hudson's Bay. According to a statement, the tech companies will take minority stakes in a new company called Saks Global. Hudson's Bay will also finance the deal with $2 billion raised from investors, and affiliates of Apollo Global Management are providing $1.15 billion in debt financing. And gold is headed for back-to-back weekly gains on expectations that the Fed will trim interest rates before year end. Spot gold traded above $2,363 an ounce. That's after rising by more than 1% this week. Silver also getting a boost from the upswing, advancing back toward $31 an ounce. And Bitcoin is sinking for a fourth consecutive trading session. The digital asset fell as much as 8.1% to the lowest since February, trading around $54,300 earlier, though it has recovered some of those losses. Bitcoin hit an all-time peak of almost 74,000 back in March as it saw strong demand after ETFs for the token were approved. But inflows have since faded, taking Bitcoin lower and dragging the rest of the digital asset market with it. That's your Bloomberg brief. Danny?
A tough market for the Bitcoin bulls. Yahira, thanks so much. Up next, in search of a soft landing.
The data that matters the most, in our opinion, ultimately is unemployment, the labour market in general. That is the spine of the economic cycle. Unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
We start your payrolls countdown. That's next. This is Bloomberg Surveillance. Less than 2 hours away from your jobs data. 190K is the estimate after 272 last month. The equity market stacks up as this. S&P 500 futures basically unchanged, 0.3%. Euro versus the dollar. Again, little change there, but some strength coming through from the euro with the stability for now of European politics, with the national rally getting a smaller share in the latest polls. Meanwhile, U.S. 10-year yield down by 2 basis points with oil markets unchanged. Manis, I found this interesting from Piper Sandler on Wednesday, talking about the equity market reaching yet another all-time high. They have dropped their coverage of the S&P 500, saying that talking about the S&P to communicate investment insights to institutional investors has become an exercise in futility. So someone not even covering this anymore. You can feel the palpable frustration of people trying to divine where this market goes next when the air is increasingly thin.
You just look at some of the calls that we've had recently. Julian Emmanuel at 6,000, Laurie Calvasino last week. She was nervous about her raise to 5,700, talking about potholes. We just had Peter Oppenheimer there. And the flow show, a lot of people have sort of said the hedgies have gone to Hamptons. So some of the, hello to the hedgies.
Everyone has but us.
Everybody's gone to the Hamptons, except for Danny and I. We're both here holding the fort. So it is about liquidity. It is about liquidity in this market. Is it time to reassess where you are? How nervous are you with your hike? But if somebody's actually cutting their coverage in terms of making calls, that just shows you the air is getting thin. And the question is, what is the oxygen that gives you the next lift higher?
Or you could be a bear that just straight up leaves.
There's no bears in this room.
Well, like Marco Kolanovic, he's not working for JP Morgan anymore. No bears, only people who have committed themselves to working the day after a holiday. Speaking of which, under surveillance this morning in search of a soft landing.
The data that matters the most, in our opinion, ultimately is unemployment, the labour market in general. That is the spine of the economic cycle. Broadly speaking, this data has been telling us for a while and continues to tell us that things are softening, things are normalising. So unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
Here's the latest. The U.S. payrolls report due out in just under 2 hours. The median estimate in our survey calling for 190,000 jobs added in the month of June. Sarah House of Wells Fargo writing this: we look for NFP gains to downshift to about 150K monthly pace over the next 12 months amid a smaller contribution from recent industry standouts and diminishing appetite for employers to hire more broadly. She's also not in the Hamptons today. Sarah joins us now. Sarah, really great to speak with you. So what's going to be the focus for you heading into this jobs report?
Yeah, so I think obviously the overall rate of payroll gains, given that, is still, for I think all of its perhaps overstatement of the overall strength of the jobs market, is still probably the best measure of hiring that we have. But I'll also be very interested in what's happening with the unemployment rate. So we've seen that move up from a low back in last April of 3.4% to 4% today. And I think that's one of the clear indications that we are seeing conditions in the labor market soften. And so I think it'll be very key to see what that does today and whether we maybe get a little bit of a dip back to 3.9% as we expect, or if we continue to see it at 4% or maybe even higher, emphasizing that deterioration in the jobs market we've seen across a lot of other indicators besides payrolls.
And you've also, after this high frequency data we've had, revised down your call. It was at 200. You're at 185 now. Sarah, is 185 enough to cement a September cut? What does the jobs data need to be looking like to suggest that deterioration that causes the Fed to move?
Well, of course, all Fed officials will tell you it's about the totality of the data. So it's not just what's happening with the labor market, but what's happening with inflation. But I think a number around 185,000 would be a clear indication that you have seen the rate of hiring step down. So over the past 12 months, we've averaged about 230,000. So over the past 3 months, it's even stronger than that. And so I think that would be an indication that the jobs market, it is cooling. And while inflation may still remain the Fed's #1 concern, I think they are having to grow increasingly watchful of what's happening in the jobs market to make sure that they don't overshoot on the downside and they don't get any untoward weakening in the labor market.
Sarah, good morning to you. It's Manus. Obviously, government has been a huge alpha here. Healthcare has been an alpha. Leisure and hospitality has been a big driver. Do you think this could be the last of the summer wine? In other words, one last hurrah with our wealth, with our dissipation in savings post-COVID? Is this sort of like the swan song for the jobs report on those three big pillars that have driven growth in jobs?
So I think we'll continue to see some outsized strength in those three sectors that you mentioned. So healthcare, there's still a lot of secular demand there. Government hiring, so we've still seen state and local balance sheets in particular in their finances, and that's about 90% of government hiring, is still in relatively good shape. Leisure and hospitality is still below its pre-COVID trend. So I think there's still a little room for those industries to provide some outsized support and limit payroll growth from slowing dramatically, but it is getting harder for each of those three to put up the sort of gains that we've seen over the past year, which has led to them combined contributing to almost 2/3 of job growth, even though they're closer to about 1/3 of overall employment. And so I think when you layer that on with the broad weakening in demand that we're seeing in other sectors, it does point to a downshift in overall hiring in the coming months, which is going to be important for how much consumers can keep spending from here if we're not seeing the same sort of labor market earnings.
Look, we're consumed by politics, more and more so. We've had the sort of the left tail shock from the Biden-Trump debate. We're now debating whether Biden will be on the ticket, etc. And one of the big issues in economics is if there is not just a Trump in the White House, President Trump in the White House, but a Republican sweep. Adam Posen was with us last week, and he talked about the serious risk of massive removal of immigrants from this country, anywhere from 1.5 million through to 7.5 million. So as you cast forward to 2025, are you more concerned about supply shock to the employment scenario or demand shock?
So I think when we look at the overlay of the political situation in the upcoming election, so I think we do see the prospect of if we were to get a Republican sweep, that's likely to be more stimulative in terms of the fiscal stance, in terms of what happens with the extension of the Tax Cuts and Jobs Act, that I think we would see those extended. And then I think when you layer on perhaps maybe a more restrictive immigration policy, I think between that more stimulative fiscal policy, but that restriction in immigration, it does point to, I think, a little bit more in inflation pressure. So it makes the Fed's balancing act between what's happening in the overall state of the labor market and with its inflation mandate, I think can make that particularly tricky.
I mean, it's a really hard economy to understand. Just look at the news flow. Saks, Fifth Ave, and Neiman Marcus are merging in part because there's a slowdown in how much people are willing to pay for luxury goods. Yet this weekend, a record number of people are taking to the roads and the skies to travel. What becomes your North Star, Sarah, in this environment for understanding the consumer?
Yeah, so I think we're looking at a lot of barometers. So looking at what's happening with that credit impulse, which we've seen weaken, what's happening in terms of the overall savings rate and how much consumers are spending relative to the income they're bringing in. But I think as we see maybe some of the tailwinds from all the fiscal support we saw through COVID, the credit channel dry up, that it really does come back down to the labor market in terms of how much consumers can keep spending. And so I think that downshift in growth that we're expecting in terms of payrolls, but also in terms of the average hourly wages. So that's going to limit your overall growth in terms of that aggregate income. I think that's going to be really important as we move through the back half of the year in terms of tempering that overall pace of consumer spending, weighing on demand, and I think also helping the Fed's battle against inflation as you do see that demand seize up a little bit more.
Well, that data hits in about an hour and a half's time. Sarah, thank you so much. Sarah House of Wells Fargo. You see that story, Manus, that Saks and Neiman Marcus are merging. Amazon Amazon's taking a stake. I mean, they're doing the low-end stuff. They're looking at giving Shein-type products and also getting their foot into luxury, too.
It just shows you sort of the tightness that we're beginning to see on retail. That high-frequency data really does begin to translate down. And, of course, to quote Paul Donovan, that ever-important quote, the hedonism of the U.S. consumer will remain strong. Keep on spending, keep on going. I'm part of it. I believe in it.
Yeah, well, we'll see if the jobs
data
data
allows... new card. I got a new card.
Manis, no spending right now. We got jobs data to focus on. Coming up, we're going to talk about Priya Misra of JP Morgan about that jobs data and more. Bloomberg's
we could start to see continuation of the softer economic momentum.
If the unemployment rate is inching higher, that should potentially be setting off some alarm bells at the Federal Reserve.
Unless we see the jobs market picking up again, it still looks to us to be an economy which is losing speed.
We can see payrolls as low as 150 probably, or as high as 250.
If we in fact actually get this very gradual decline in labor market pressure, I think that's actually quite a good outcome.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide. Good morning. It is Bloomberg Surveillance. I'm Manish Kranny alongside Danny Berger. It's not your usual lineup for Jobs Day. Politics, you have the two of us. Danny, it's a fascinating time to come into work on the 5th of July, just from the political side, but from the job side. This is the day that maybe the dual mandate really rises in ascendance in terms of the numbers that we're expecting on the non-farm payrolls. The whisper number stands at 185,000. Incrementally, people are coming down at the moment.
I think it is after a weak ISM data earlier in the week, the weakest for services since the heart of the pandemic. That's really emphasized the importance of this labor market data. You get a real sense that we see this weakening in the economy, but so far it's been in the high frequency data, dare I say the tier 2 and tier 3 data. So this needs to be our North Star. It is something that we can really hang on to say, is this enough to cement any sort of Fed cut in at least September?
Well, it's going to be interesting to see what happens with the unemployment rate, whether it breaks above that 4% level. That's going to be critically important. And then for the consumer, how much do they have in terms of their spending power on real wages? Check in on the markets. The bond market had some virulent moves running into your shortened trading day on Wednesday. SPOOs are flat at the moment, 55.91. You are looking at record after record there. The Nasdaq made another all-time high. Euro dollar trades at 108 as it looks as if the dollar is slightly more on the back foot at the moment. And you have 10-year yields. This is the critically important pricing point for all growth stocks and all markets. 433 is where we are at the moment. Again, what does it take for the bond bulls to be reinvigorated? There was a huge amount of burst steepening in the last 6 days running up to the July 4th holiday. 433 is where we are. You're going to need a heck of a soft number to take you down to 425 before you open a new band with below that. And crude trades at 83.80 at the moment. So it really is, what does it take for the bond bulls to be reignited here?
I'm also interested in what difference does it make to this equity market, an equity market that's been led by really thin air. Piper Sandler dropping their coverage entirely of the S&P 500 earlier this week, I think is so telling. The fact they say for our clients, giving them a price target for the S&P 500, it's an exercise in futility because it doesn't tell you anything about this market. If you look at the rest of this market, Manis, it has been trading some of this economic weakness. So if we get a weaker number, does that fuel it? Does it continue to be the only thing you can buy at this point is Nvidia?
Well, maybe what reinvigorates not just the growth. I mean, the growth narrative at the top is resplendent on its own. It's responsible for the free cash flow. It's got dividends. It's got buybacks. It's got everything that you didn't have in the year 2000. But in terms of the yield, breaking that 425 area, which was everybody's focus in terms of the market, you're going to need a softer number, and not just a softer number, but you're actually going to need the narrative to shift to the door opening to a September rate cut and trying to reaffirm 2 rate cuts for this market 2024.
You've had a little bit of that, right? Again, as I say, the high frequency data has pointed to this. So I can't help but wonder if the risks are asymmetric to hotter data, that potentially this is a market that is unprepared for what we got last week, which was the data rolling in higher than we expected, higher in a good way. Because we did look at jolts, that was confusing. We didn't know what to make of it. So we're entering this period of confusion, this push of pull of what do we trust more, our fear about the economy or fear of higher deficits?
Well, the fear of the economy is becoming ever more prescient and ever more real. You've got got services dropping to the lowest level in 4 years. You've got manufacturing. We know manufacturing is under pressure, services under pressure. So incrementally, these negative surprises are coming. We had Goldman Sachs a little bit earlier, Peter Oppenheimer, saying the macro backdrop is softening. Their macro surprise index is negative. It's a question of whether that very, very left tail risk, which is the word or, which is not the or star, but it is recession, and whether that rises, not necessarily a full-blown recession, just as I've been saying through the morning, the double soft.
Yes. Well, let's be honest. The employment picture typically does not move in a linear fashion. And that's what it has been doing. So that is the fear. If we get a bigger tick up in unemployment today, something even remaining at 4% or going to 4.1%, is this the start of a nonlinear move?
And we will get to it a little bit later on as to whether this really is the put up or shut up weekend for the President of the United States of America. Will Joe Biden remain? He has a big interview on ABC today. We'll talk more about that in just a moment. The headwinds for Biden remaining on the ticket. Coming up, Priya Misra of JP Morgan as traders await the latest U.S. payrolls report. Jordan Fabian as President Biden heads into, as I say, this make or break weekend for his campaign. And Pooja Kumra of TD Securities after the big win for the Labour Party in the United Kingdom. But we kick off this Friday with the big story. Global stocks are trading near their all-time high. That's ahead of the key payrolls data. JP Morgan's Priya Misra writes this. Our high-frequency measures suggest a slowing in pace to around 175 to 200,000, but I think that is priced into all markets. I think the risks are skewed to the downside. Priya joins us now. Priya, good to see you. Very good morning. And thanks for working 5th of July. So the risks are skewed to the downside. The question is, how substantial a slowdown do you think we are going to see over the next 6 months?
So again, the day, I would argue end of cycles are always tricky because it's hard to sometimes disentangle the signal from the noise. I mean, the economy is, no question, the economy is slowing. Are we slowing to trend, which would be that 150 to 200,000 payrolls? Mm-hmm. Are we slowing below trend? Recessions always tend to be non-linear. I think what we see so far is we're slowing to trend. But can it worsen? It can absolutely worsen. I mean, there are some signs, ISM services, the JOLTS data, we're right at that inflection point, which is why I think this number is very important. If we see a number 150 or below, and I think we should also all think about what is break even. Historically, we would think 100,000 was break even, but with where labor supply is, maybe 200,000 is the new break even. So if we actually grow at 150,000, maybe that is that non-linear slowing. So, I think we're still optimistic that the soft landing holds, but I would say that tail risk, as we think about the risk to soft landings are all about risk management. There is this tail risk of reacceleration. I think that has been put away. There is the tail risk of a recession. And I think if we see a slowing, even 150, which, 5 years ago, I would say, 150 is fine. I would get a lot more nervous that things are slowing down. Maybe the cracks in the economy, there are cracks in the economy in the low-income consumers. Is that strong enough that companies are starting to pull back hiring? So I think we're at that, I would say I'm nervously optimistic, but that level of nervousness is higher today, or is the highest, I have to say, in the last few years.
Should the Fed just be positively nervous then in that case? Because the argument, the clarion call that's going to go up is they are behind the curve. If it is a soft number, that's what's going to happen, and the swaps market is going to price in a more aggressive cutting trail.
So I think the Fed is, as much as they can, telling us that they're nervous. Here's how I see that. They've been singularly focused on inflation. What we've heard in the last few months, and we heard it again from Chair Powell this week, is that the risks are more balanced. Well, why, if the labor market is so strong, and inflation is still we're at 2.6 on PCE. Maybe they argue that's close to 2%, but it's still above their target. The unemployment rate is still 4%. Why are the risks balanced? I think the Fed is looking at these cracks that I talked about, that the economy is bifurcated. There are parts of the economy where there is weakness. And the Fed is saying, well, what if this deepens? What if that's enough to offset the strength elsewhere? They're telling us they're nervous. But I think the Fed is somewhat of a cheerleader for the economy. I don't think they can come out and say, what do they know that we don't know? They can't come out and say, we're nervous about the labor market. They're going to let the data speak. Yeah. But I think to your point about rate cuts, that's going to happen. I think the Fed's telling us, unless inflation really surprises to the upside next week, and we have a big CPI report coming up, they're ready to start to cut. I think they're telling us that they've got two paths. They either cut soft landing cuts. So they cut to 3.5%, or they cut a lot more. They're telling us that put, even though they never want to say that, but if things get worse, they're going to cut a lot more.
So you think the Fed put is alive and well? And if it is that also a problem? Because essentially what they're saying is we're here to support this market. We're here to support a hot equity market that's also been giving people this wealth effect as we continue to hit new highs.
So I think the put for rates is there. The put for risk assets really depends on the lag. And what we've learned in this cycle is the lags are long and variable. So the Fed can absolutely cut a little fast. Does that really stoke the economy? Now, again, it might stoke risk assets, but it might take a while. If the unemployment rate starts to rise, even if the Fed cuts aggressively, it can continue to rise. It takes a while for these rate cuts to start to feed through into the economy. So I think people may be a little complacent that, if the Fed cuts and the economy is in a recession, that's fine. It may take a while. So I think they may have to be patient. So, and I think on financial conditions, it's context dependent. So I don't think the Fed really looks at financial conditions in absolute. If the economy is weakening, they'll be fine with easing financial conditions because that's what they should do to try and stoke the economy to, a better level.
But we still have seen from things like the Fed minutes, for example, that there are still policy members, committee members who are talking about if inflation does surprise to the upside, they're willing to hike. You hear that from Michelle Bowman. The language is there. So even if Powell does want to cut, and some of the other more dovish policymakers like Mary Daly want to cut, will they be able to, with the presence of still these hawkish members that are still clamoring, we are not there yet and you need to be patient?
I think the way they can finesse that message is to say all we're doing is normalizing. We're not easing. The fact that inflation a year ago, PCE was at 4.5 and now it's 2.5. That's a 200 basis point increase in real rates. So I think the way they can try and square that circle is we're normalizing, we're not easing. Now, if the economy deteriorates fast, I'm pretty sure the hawkish members will also say, well, maybe we should ease a little bit, or let's normalize really fast. So I think they remain data dependent. I don't think you'll hear from them mission accomplished. Inflation still north of their target. Political uncertainty, credibility, that's a big question. It's making it, all of this talk around the Fed and political independence is making it, I think, harder for them to cut. But they've been very consistent as long as inflation doesn't resurge here, that they're going to start to cut.
Well, the narrative is, of course, harmonized inflation, has dropped so aggressively that technically, we're in a tight band in rates at the moment. Maybe that's what today's data will tell us. You stick around. Priya Misra from JP Morgan, our guest. We're going to catch up on politics. We've got update stories for the rest of the morning. Here's Bloomberg's Yahara Jacquez.
Hi, Manis. We start in France, where Marine Le Pen is dismissing projections that show her far-right National Rally Party is set to fall well short of an absolute majority in the country's legislative election. Surveys showing the National Rally and its allies are on course to win 190 to 250 of the 577 seats in the National Assembly Sunday. That's well below the 289 that would enable them to push through their agenda. But Le Pen staying defiant, telling a TV channel in France they have serious chances of getting an absolute majority. Meanwhile, in the UK, Rishi Sunak saying he will resign as the leader of the Conservative Party once succession arrangements have been made. This as he steps down as Prime Minister after his party's devastating electoral loss. Speaking just over an hour ago, Sunak said, quote, "I am sorry. The British people have delivered a sobering verdict. I take responsibility for the loss." The outgoing Prime Minister congratulated Keir Starmer on Labour's landslide victory. That's your Bloomberg Brief. Manis?
Yahira, thank you very much. Up next, President Biden's make or break weekend.
I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. We were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign. I think they've got 5 or 6 days to make a decision.
That is up next. We're into the crunch zone on the Biden remaining on the ticket. You're watching Bloomberg Surveillance. Good morning from New York.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest premieres Monday at 9 a.m. Eastern, only on Bloomberg Television.
It is Bloomberg Surveillance. Let's give you a quick snapshot of this market as we are counting down to the non-farm payrolls number. 190,000 is the consensus. We are seeing a whisper number come in a little bit lower than that. You've still got hot stocks, 33 record highs. You've got the euro dollar trading flat at the moment, up 0.1%. And treasuries, all eyes down, yields tick down by 2 basis points. Again, really on politics dominated. Now it is the data. Is it a softer jobs report that takes you to the lower band of 425 and breaks through there post those burst eveners that you have had? Under surveillance this morning, President Biden's make or break weekend.
I think the race has changed fundamentally since Thursday night. Absolutely. We want to see if he's going to stay in the race before we make any additional call from here. I think that if Biden steps aside, they will try to engineer it so that Kamala, the vice president, ultimately locks up the nomination. We were telling clients yesterday on a call that we thought there was 3 weeks for the White House or for the Biden-Harris campaign. I think they've got 5 or 6 days to make a decision.
We're now down to days for a decision to be made. Here's the latest. President Biden is preparing for an interview tonight with ABC. It's going to be his first major appearance since last week's poor debate performance. Now, this comes amid mounting pressure for him to drop out of the race as a new Wall Street Journal poll shows Donald Trump's lead over Biden is growing 48 to 42. That has widened over the past couple of days. Jordan Fabian is with us for Bloomberg News. Jordan, we've just caught up with Eurasia. They think a 25% probability for Biden to drop out is being generous at this stage. How pivotal will this weekend and this interview be in terms of making that decision for Biden?
I think it's huge. The American people want to see whether Joe Biden still has what it takes to be commander-in-chief, not just till the end of this year, but for another 4 years. And so far, Biden's reassurances have mostly come behind closed doors. So this interview is a chance for him to speak directly to the public without, notes. This is an interview. He has to speak off the cuff and really reassure people that he's up to the task. So it is huge. And also he has those battleground state stops today in Wisconsin and also on Sunday in Pennsylvania. That's a chance for him to get out in front of those voters who are going to be making that decision in November.
The narrative, the political narrative, is that Kamala Harris, the vice president, is the very obvious person to go to. She can get her hands on the war chest. She is the right person to do this because essentially this is a politically poisoned chalice. And why would any of the other potential suitor names out there want this?
Right. You look at some other names being floated out there, like the governor of California, Gavin Newsom, Illinois Governor J.B. Pritzker, Michigan Governor Gretchen Whitmer. These are all governors with national profiles, people who, people in Democratic circles see as having political talent. The problem is, if you were to pass over, the first black, female, Asian vice president in favor of those 3 white governors, it could really demoralize a segment of the Democratic base that they need to turn out. And not to mention all the practical questions that you just talked about, access to fundraising, replacing names on the ballot, making sure that delegates are sold on this plan. Those are all easier in the eyes of Democratic insiders going to Kamala Harris than someone outside the administration.
Can't help but wonder, though, Jordan, as a Democratic consultant, Howard Wolfson put it, when you're driving a car off a cliff, there are risks to swerving right or left. If we do get Biden stepping down, is there a risk that this somewhat creates infighting and chaos and feuding within the Democratic Party? In other words, is there damage already done that by simply putting a new candidate at the top of the ticket, that it will not fix it?
Oh, absolutely. Replacing Joe Biden would be a Hail Mary pass at this point for the Democratic Party. You cannot understate the damage that President Biden did to his candidacy with his performance in that Thursday debate. And to your point, replacing not only just a major party presidential nominee, but an incumbent president at this stage in an election is unprecedented in modern U.S. history. It would be incredibly disruptive, even though there are a lot of voices saying the party should rally around Kamala Harris if Joe Biden were to step down. There's going to be a lot of people who say, that's not a good idea, and point to her, flubs in the past, her inability to gain traction as vice president. And so you would have that infighting, and that's not what you want as a political party going in to win an election, especially against somebody like Donald Trump, who Democrats are warning pose a threat to U.S. democracy.
Right, but Donald Trump's big argument has been Joe Biden's age and his, well, not necessarily his age, because they are close in age, but his cognitive abilities. So if Biden is replaced by someone younger, what does Team Trump do? Because, again, this has been their big argument, bringing to voters, saying, look how much more together Donald Trump is than his opponent.
Right. They would certainly have to pivot their strategy. He was caught on this hot mic sort of disparaging Kamala Harris. And so if she were to be the pick, I would imagine that he's going to dig into whatever personal foibles that person has and put it out there. I mean, look at what he did to Hillary Clinton in 2016. That's the playbook he uses. Get down and dirty and personal. But like, this is the thing that Democrats are grappling with, right, is that if they were to change out Joe Biden, it would certainly be disruptive, but it would also change the dynamic of the race, introduce some new face, and also remove that question of age from the equation.
Yeah, well, certainly at the moment, it looks as if Trump, relatively speaking, is playing the relatively quiet game, challenging, asking for another challenge, a one-to-one debate. But right now, all they got to do is stand back and watch the Democrats tear one another apart in terms of what happens next internally about the ticket. Jordan, thank you very much. Jordan, Fabian there. Our guest this morning is Priya Misra at JP Morgan. She's still with us around this desk for Jobs Report Day. It's very interesting. The equity market, Danny and I have talked about record after record, the bond market. The bond market went from data to politics like that. And it was like, steepeners are us. There was such a virulent steepening on the prospect, not just of a Trump in the White House, but a Trump and a Republican sweep. And that invoked the wrath of the bond vigilantes. My question to you is this. The steepening that you've seen, is there a sense of exhaustion with that? Or is there more of that to come as this political race runs forward?
So I do like steepeners. I think if the probability of a Republican sweep goes down, there could be some knee-jerk flattening because we've just steepened a lot. But the reason for the steepening, I think, is twofold. The market's pricing in some Fed cuts, absolutely, 50 basis points this year, 75 next year. The end point is still 3.7. I mean, you've heard from President Williams. I think there's a view that the Fed will cut to, even in a soft landing, to 3%. So there is room for that front end to rally. Once the Fed starts to cut, I think we all start focusing on how much are they going to cut. Right now there's this probability that they don't cut. So I think as the cutting cycle starts, that front end has room to decline. Now, on the long end, there's the supply question, and I think that should make that term premium move higher. So you can actually see a bit of a twist steepening where the long end can actually stay there or sell off in a Republican sweep. The front end can rally. I think the front end is all about macro fundamentals here. How much is the economy slowing? The long end is more supply. Is this inflationary? The Fed might be in a really tough spot because they want to cut as growth is slowing. Yeah. But what if the combination of between immigration, deregulation, fiscal, that there's actually inflation down the road. So as that inflation risk premium rises, I think that curve can steepen. So I think steepeners are the way to trade this market from a risk reward standpoint.
When it comes to duration, part of the thing that I find fascinating about this is that either candidate is going to be fiscally positive. It's not necessarily like we just realize that all of a sudden after the debate. So if that is the case, as Stephen Major says, is it not already priced in? Is that risk premium of more supply, is it already baked into the picture? Because, again, we know, regardless of whether it's Trump or Biden or someone else, it's a challenging deficit and challenging growth of deficit going forward.
So that's fair. We've got this unsustainable debt trajectory. But here's where the House and the Senate, Congress becomes extremely important. So I think in a Republican sweep or a Democratic sweep, you can still say that both will mean more deficits. What happens in divided government? If you have the Congress different from the White House, trying to get big fiscal policy done or even the extension of the tax cuts, I think all of that comes into question. Markets find it hard to, these are all binary risks. So I think we're all focused on the White House. Yep. We have to look at every House as well as Senate race to try and figure out, is this a sweep or is this still divided government? I think that's the difference for the bond market.
And that is going to come down to the fiscal mandate that's handed. As you say, look, this could all be shredded by Monday. We just don't know who's going to be on this ticket, but it sounds as if the president is going to stick with it. Priya, thank you very much. Priya Misra there of JP Morgan, our guest on the bond markets. Coming up, Pooja Kumra of TD Securities. You're watching Bloomberg Surveillance, live from New York City. A very good morning. It is Bloomberg Surveillance. You're looking at a live shot of number 10 Downing Street. The incoming new UK Prime Minister, Keir Starmer, has taken that short ride from Buckingham Palace down along the Mall, back into Downing Street. He arrived, we just saw it a few moments ago, at the rear entrance of the seat of power, which Labour have acceded to with a pretty stunning majority. Danny, I mean, this is Stramageddon. He has a mandate, but as a number of our guests and various people have said, it is a mandate, but it's wide, but it's possibly just a little bit thin. He's got to bring the country with him fiscally, along with policy, in a whole host of ways, because he has got challenges.
Keir Starmer, the thing that Rishi Sunak had said about him was, don't give this man a blank check. Don't give the Labour government a blank check to spend and do whatever they want. It doesn't matter how much of a share that they won. They don't have a blank check. To your point, Manus, first of all, they have a bond market that is very clear in the UK. It can give them a check, and no one wants a repeat of Liz Truss. But the other thing, and you've talked about this really well, Manus, the fact that they don't have fiscal wiggle room. Their incoming investments don't look great. Weak public infrastructure, and he simply can't throw money at the problem given the deficit. So the kind of growth that we're going to get, that is the question. That's why the Chancellor Rachel Reeves has said this is the most challenging outlay, the most challenging handoff since World War II.
Many people assumed that it would take Keir Starmer and this version of the Labour Party 10 years to get back to power. That has happened a lot more quickly and expedited a lot more aggressively, as this was a vote against the Tories. And it was a vote for reform, which is led by Nigel Farage. Again, this was a much contested election around inflation, around taxation, the burden of taxation being so aggressive on the middle class. And these are the contentious issues, the promises of Brexit. This is a party, the Conservative Party, the Tory Party, that took you into the Brexit referendum. And in many ways, those immigration promises, those fiscal promises, those freedom and growth promises simply have not been delivered.
And it's not just that. If we take a step back and look at what's happening across the world, it is the year of the anti-incumbency. That's what people want to see. They want to see a change. And save for the UK and Mexico, it is a world that is moving more to the right, more protectionist, more isolated, more nearshoring. So I'm going to find this fascinating. The mix of a Labour government that doesn't want to do away with Brexit, but perhaps want to open themselves up to Europe, to more trading powers, but perhaps an increasingly less friendly Europe, especially as we watch things shake out in France. How do those two things play against each other?
Europe have their own very particular form of problems themselves to deal with. They have a lurch to the right, not just in France with Marine Le Pen, but also AfD in Germany. And this is perhaps underreported. There was a demonstrative shift to the right in the United Kingdom. The Reform Party, headed by Nigel Farage, a close confidant of Nigel Farage, certainly in the previous campaigns. Whether that friendship still remains is to be debated. But there has been that move by the electorate to Nigel Farage that's demonstrable. Labour took 34% of the total vote. So it is a broad mandate in the House of Commons, but it is supported by quite a small narrative from the populace of the United Kingdom. Pooja Kumra, TD Securities, is our guest this morning. Pooja, good to have you with us. I mean, here we are. We're looking at significant change about to hit the United Kingdom. For the moment, markets, the pound, the gilt markets seem steady on their feet. Will that honeymoon endure?
When it comes to, yes, as you said, Labour, right now we are just done with the easy part of the election. It was pretty much expected that Labour will get the win. And I think after a long time, after Brexit, we are basically entering the phase where there'll be much more political stability that we have not seen. So, yes, it's great for the market. But again, as we mentioned, that it's Labour has a lot of challenges to actually meet up to. But on the positive side, they're actually coming in when growth has started to improve in UK, as well as we do expect BOE to actually start cutting rates, which means that generally interest expenditure is also going down. But definitely there's lots for Labour to live up to right now, given the kind of strong win they've seen.
Well, certainly a 60% probability that the Bank of England goes in August. That may well be ahead of the Fed. In terms of the gilt market, this is going to be critically important. The fiscal plan that they have an autumn statement in the United Kingdom, and then they have a budget later in the first quarter of 2025. You would say that the flow of money, and this is what we've heard from Goldman Sachs, I want to understand from you, the kind of flow from international parts into the gilt market, you think it is supportive, this Labour administration will be supportive to the gilt market with rate cuts. How supportive?
Yes, no, totally. This left is very different from the left we are talking in France right now. So they do not want to actually do the trust thing again. I doubt they are going to change much in terms of their fiscal when we head to the autumn statement. More changes are likely to happen in the March statement. So I think right now gilts in a very nice position given the fact that you have so much turmoil when it comes to political uncertainty in France as well as in US as we head towards whether it's Trump versus Biden. So I think from a fiscal perspective, cross-market wise, gilts is in a very good place, and we actually like holding gilts on a cross-market basis here.
You do make a good point, Pooja, and this is what I was talking to Manis about, that it is not just France. It is election upsets throughout the globe, as it is a world that moves more right and potentially more protectionist and more isolated. What does it mean for the market to grapple with that? Because at the moment, we've been trading this as just idiosyncratic stories between each individual nation. It matters for the peso. It matters for French bonds. But what happens when this global story comes together and globalism, the engine of growth, takes a back seat?
No, that is definitely the scary part, that it impacts growth. It's also inflationary. And I think that is something that those are the effects we are actually going to see going forward. And that especially holds for Europe, because Europe has created this strong integration, and that is definitely at risk as we head towards Sunday elections.
And as we head towards Sunday elections, Pooja, again, this is a market that is treating this like a near miss. The spreads are still wider, but they have come in because you don't have Marine Le Pen's party, the National Rally, securing as much as a majority. Is it the all clear for you as well?
So we are going to these elections a bit complacent. At this stage, markets are viewing a hung parliament as positive for OATs, just given the fact that no decisions will be being made, just given the fact that there won't be any clear majority. But I do feel that it's not good for France growth as well as deficits. They won't go lower, but I don't see them improving, just given the fact that we are basically, the options right now is either it would be hung parliament with RN as a majority or a hung parliament with a severe breakdown right now, which could also mean we head into a technocratic government, which is definitely negative growth and not positive for France. So even though OATs versus Bund spread, the general levels are pretty much contained, I don't think we are getting back to the 45 level that we saw ahead of the snap elections.
In terms of just stepping back for a moment, Danny framed this, I think, very well earlier on, which is the discontent with the status quo in many democracies, not just the United Kingdom, not just in France and in Germany. There is also a discontent here in the United States of America with the status quo. We're seeing that in the polls at the moment between Biden and Trump. From the global capital flow, and this is what I'm curious to understand, there is this suggestion that with a new form of government and taxation in the United Kingdom and coming potentially in France, that you will see a material dislocation of global wealth flows from the UK and from France. How might that play out on the stage of global investing? Do all roads ultimately then lead back to the United States of America?
I mean, I think there will be there is already a shift of flows happening since the COVID crisis, where all countries had to actually were forced to be self-dependent than actually being dependent on others, and that also happened during the Ukraine crisis. So I'm not thinking of a big major shift, but that's the way we are going into. I totally agree with your point, but I think I mean, UK is still a market which is basically owned by non-domestics. I mean, especially when I talk about the fixed income space. As long as we are able to show that kind of stability, I do see a lot of flows coming into UK for sure.
We're just looking at live pictures here as you're talking to us, Pooja. This is Keir Starmer and his wife. They have just arrived now to the front doors of Downing Street. He is walking along, greeting the crowds. You know, this is very reminiscent of 1997 when Tony Blair and Cherry Blair arrived in Downing Street, which is where they broke with that very traditional formal process. They're greeting the guests here. Starmer has a heck of a job in front of him. Sterling is giving him grace and favour. Excuse the pun, of course, living in number 10 Downing Street. They are grace and favour apartments. The Chancellor lives at number 11. He has a young family. Sterling, up for 7 days in a row, Danny, the longest winning streak in 4 years. Grace and favour for the moment.
It is, but how do they revive growth at a time where the fiscal drag is weighing quite heavily on the UK, where you don't have that investment coming in? Perhaps it is like Pooja and Peter talked about, this idea that you can get inflow because the UK becomes a place of stability. But is that enough? This is a Labour government that has moved towards the centre and cannot spend as they want to because they live with the ghost of Liz Truss.
Well, the ghost of Liz Truss, who has lost her seat.
Yes.
It should also be added. There will be some commentary,
First
I'm
Prime
sure,
Minister to do so.
Around that, yeah. The Chancellor of the Exchequer, the former Chancellor of the Exchequer, did indeed hold on to his seat. The fiscal framework, and this is worth just touching on. The promise by Keir Starmer here with his wife greeting the crowds at number 10 Downing Street. The fiscal framework, if he can change the fiscal framework, which is about saying to the gilt market, I want to borrow more. I've been very clear with you, £9 billion or thereabouts, £8-9 billion. But if I'm going to borrow for growth, is it something that the gilt market will absorb easily rather than perhaps the reckless proposition as it was assumed by Liz Truss?
And I love this, again, from Katie Martin over at the FT, saying that this market knows that there's a difference between borrowing lots of money in a suit and borrowing lots of money in a clown outfit. I'll leave that to you to assume who she's talking about is borrowing in a clown outfit. But the assumption is that this market is trusting that Keir Starmer understands what this means. I was talking to someone from Signum Global last week who said to me, look, they understand that this bond market can push them out of government. France understands that it can push them out of this presidency. And that's exactly why some of the language you hear coming from France as well has been more moderate, has been more tamed, trying to reassure the investor base, because no one wants to be that prime minister. No one wants to be that president that is bullied out by a bond vigilante.
Well, maybe they all went to Italy for a quick chat with Ms. Meloni, in that, again, the panic was that Giorgia Meloni would incite a widening of the spreads. The Prime Minister of the United Kingdom, Keir Starmer, is about to address the nation and the world.
Thank you. Good afternoon. I have just returned from Buckingham Palace, where I accepted an invitation from His Majesty the King to form the next government of this great nation. I want to thank the outgoing Prime Minister Rishi Sunak. His achievement as the first British Asian Prime Minister of our country, the extra effort that will have required, should not be underestimated by anyone. And we pay tribute to that today. And we also recognise the dedication and hard work he brought to his leadership. But now our country has voted decisively for change, for national renewal, and a return of politics to public service. When the gap between the sacrifices made by people and the service they receive from politicians grows this big, it leads to a weariness in the heart of a nation, a draining away of the hope, the spirit, the belief in a better future, that we need to move forward together. Now, this wound, this lack of trust, can only be healed by actions, not words. I know that. But we can make a start today with the simple acknowledgement that public service is a privilege and that your government should treat every single person in this country with respect. If you voted Labour yesterday, we will carry the responsibility of your trust as we rebuild our country. But whether you voted Labour or not, in fact, especially if you did not, I say to you directly, my government will serve you. Politics can be a force for good. We will show that. We've changed the Labour Party, returned it to service, and that is how we will govern. Country first, party second. Yet, if I'm honest, service is merely a precondition of hope, and it is surely clear to everyone that our country needs a bigger reset, a rediscovery of who we are, because no matter how fierce the storms of history, one of the great strengths of this nation has always been our ability to navigate a way to calmer waters. And yet this depends upon politicians, particularly those who stand for stability and moderation, as I do, recognising when we must change course. For too long now, we've turned a blind eye as millions slid into greater insecurity. Nurses, builders, drivers, carers, people doing the right thing, working harder every day, recognised at moments like this before, yet as soon as the cameras stop rolling, their lives are ignored. I want to say very clearly to those people, not this time. Changing a country is not like flicking a switch. The world is now a more volatile place. This will take a while. But have no doubt that the work of change begins immediately. Have no doubt that we will rebuild Britain with wealth created in every community, our NHS back on its feet facing the future, secure borders, safer streets, everyone treated with dignity and respect at work, the opportunity of clean British power cutting your energy bills for good. And brick by brick, we will rebuild the infrastructure of opportunity, the world-class schools and colleges, the affordable homes that I know are the ingredients of hope for working people, the security that working-class families like mine can build their lives around. Because if I asked you now whether you believe that Britain will be better for your children, I know too many of you would say no. And so my government will fight every day until you believe again. From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off. You have given us a clear mandate, and we will use it to deliver change, to restore service and respect to politics, end the era of noisy performance, tread more lightly on your lives, and unite our country. 4 nations standing together again, facing down, as we have so often in our past, the challenges of an insecure world, committed to a calm and patient rebuilding. So, with respect and humility, I invite you all to join this government of service in the mission of national renewal. Our work is urgent, and we begin it today. Thank you very much.
Keir Starmer there and his wife, you can see Victoria standing in the crowds outside number 10 Downing Street. This is tradition. The incoming Prime Minister makes a speech to the nation, sometimes setting the agenda. And very clearly they're talking about two of probably the most important agenda issues that Labour campaigned on. The National Health Service in the United Kingdom, making it better, and border control. The Tories had introduced, some would say, a very toxic immigration policy that was tough for the country to chew on. Labour, let's see what they deliver. Danny, he talks about energy bills. He talks about all the issues, really, that he campaigned on. Be calm, be patient. This is about rebuilding Britain.
Brick by brick, we will rebuild the infrastructure of opportunity. And within that same breath, he went on to talk about the importance of rebuilding the infrastructure of schools, of homes. But this comes back to what you and I, Manus, were talking about, of does he have the fiscal headspace to do that type of spending? You could look at their budget and say he does not have the fiscal headspace to do that. And I think that's why you also hear the language of patience. Be patient with us. This will take a while. Rachel Reeves, his Chancellor of the Exchequer, said something similar, that this is the most difficult inheritance since World War II. So they have this path laid out, but they know they can't jump into it, that they have to take their time because, again, they don't have that fiscal room to spend in order to get it done.
Yeah, let's just have a look at some of the UK assets. We've had two guests this morning talking about the appeal of UK assets, that island of stability relative to France, relative to the rest of Europe. And this is what you've got. You've got 10-year government bond yields at 4 1/8, ticking down ever so slightly. Cable trades at 127.84. That has been on a run, Danny, up for 7 days in a row into this. Starmageddon is being taken well by the markets, and the FTSE has been making record highs, as we know. It's the longest winning streak on sterling in 4 years. We're in a disinflationary at a full employment world, according to Andrew Bailey at the Bank of England. The US jobs report hits in just under an hour. Sarah Wolfe from Morgan Stanley joins us now with her outlook. So we've had a couple of conversations, Sarah, good morning to you, about the jobs report. We're looking for 190. The whisper number is a little bit lower. Are there fissures in the strength of the US job market apparent to you? Good morning.
Good morning, and happy 4th of July week. I think there's two things we should be watching that are showing that demand for labor is coming down and supply for labor is waning. And I think both of those factors could be weighing on the labor market report that we get this morning. It's one of the reasons why we have 160,000 on private payrolls. That's a pretty notable slowdown from 230,000 last month. If you look at the supply numbers, immigration flows have been stepping down pretty notably since March. And so that's going to start to feed into weaker leisure and hospitality jobs, weaker construction jobs. And then on the demand side, vacancy rates have been coming down. Initial jobless claims have pretty convincingly been moving higher. And so I think both of those things show us that the labor market, it's still strong, but it's not nearly as tight as it used to be. And you could say that it's in balance right now. And so there's two-sided risks that we need to watch.
With two-sided risk, the expectation is for 4% unemployment rate at the moment. Do you think that we're going to go into a period of accelerated unemployment? And if so, at what kind of speed? If it is a low dip number, as you say, at around 160?
We have 4% unemployment rate unchanged. And because you have two factors that are weighing on the unemployment rate to the upside and the downside. So if you have a supply-driven slowdown in non-farm payroll, so labor supply is coming down, that actually could push the unemployment rate lower down to 3.9, even with a weak payroll print. However, if it's demand driven and labor supply is continuing to rise, that could actually push the unemployment rate higher to 4.1. So there's two-sided risks. We need to be watching the details of the household survey very closely and what happens with the participation rate. More broadly, we are expecting the unemployment rate to get all the way up to 4.2% by the end of this year, which is a bit higher than where the Fed is. We think that's going to be one of the things that pushes the Fed to cut 3 times this year.
Michael Reed over at RBC, Sarah, thinks that it's going to be the supply side. And here's his argument. I want to know what you think about that he thinks the labor market is going to remain tight because of a generational thing, because baby boomers are going to start retiring en masse. And that's why we're going to have a tight labor market. What do you think of that?
That's absolutely true if you look more at the medium and longer term horizon. But we've been having a demographic headwind on the labor force for over 5 years now. One of the things that really is the wild card, though, on how powerful that demographic force is going to be is how much we can increase the working age population through immigration. So for context, right now, the native-born population is only growing by 0.2% on the year, whereas the immigration population lifted overall population growth to over 1.5%. So it's having massive tailwinds offsetting the demographic headwinds. And so that's going to be a huge wild card, especially going into the elections in November and what type of immigration policy we see.
It is a fog for 2025, in the words of Lori Calvasina. Sarah, in that fog, Jan Hatzius over at Goldman had a note out on Wednesday saying that if you take immigration together, along with the tariffs that Trump wants to pursue, that would result in an economic environment where the Fed would have to hike a total of 130 basis points, about 5 hikes. What is your concern? Do you share that concern? 5 hikes from the Fed would be quite remarkable, as we just got a glimmer of a cutting cycle.
We actually take a bit of a different view on the post-election outlook in a Republican sweep scenario, which would result in tighter immigration policy as well as higher tariffs. And it's a little bit complicated because you have weaker growth coming out of a negative supply shock from labor. And then you also have weaker growth because of demand destruction caused by higher tariffs. And then out of that, you can have higher price levels, which tend to come later. They're a little stickier. And so in our view, that negative hit to growth is actually could cause easier Fed policy in 2025 because that inflationary component comes later, more a 2026 story. So we actually have a bit of an opposite take on the 2025 outlook in risk to growth and inflation and Fed policy.
We'll take that contrarian view. It's certainly one to put in the mix. As you say, tariffs could indeed weaken the demand overall. Sarah, we're counting down to that jobs report. We'll see what the number is. We'll see what the unemployment numbers are and the wages as well. Sarah Wolfe at Morgan Stanley. So it's interesting, isn't it? That contrarian kind of take on it, isn't it?
But again, it's this fog for 2025. Good luck trying to trade this bond market and trade Trump in a day like this, in a year like this.
Let's see what the fiscal landscape looks like. We're counting down to the jobs report. Nadia Lovell from UBS, Randy Kroszner, the Chicago Booth School of Business, Jeff Rosenberg of BlackRock, along with the team from Bloomberg, Ira Jersey, join us to break down the jobs report right here on Bloomberg Surveillance. Good morning from New York.
What's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market.
What I see from the data is certainly a loosening in the labor market.
I think the risk is that the unemployment may rise a little bit, not a lot, but a little bit from here.
We may be at a kind of inflection point in the labor market where you're actually going to see more weakness on the unemployment rate.
You can have two things be true. We have a good labor market, and it is weakening.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes until your jobs report. 190 is the estimate from New York City for audience worldwide. Good morning. This is Bloomberg Surveillance. We're taking over the show today. It's me, Danny Berger, alongside Manus Cranny, John, Lisa, Anne-Marie. A well-deserved break on for us what's a busy day for everyone still out there who decided to come into work after 4th of July. We have jobs data to grapple with, Manus. The question will be is how weak does it look to, one, not only make the Fed cut and lock that in, but to move this bond market?
Yeah, I mean, the bond market has been slapped around, hasn't it? It had political curve steepeners that went ballistic. And then there was the data. Services slowing down to the slowest level in 4 years going into this. So the narrative suddenly shifts for the bond bulls again. They were emboldened and then they were slapped by the steepener. The question is, Danny, what is it that takes them to 425? Is it an unemployment rate that steadies at 4% and ticks a little bit higher? Incrementally over the past 2 hours, we've had a number of calls which have gone to the left-hand side of this number, the consensus of 190. We've had a call as low as 160.
Can I just say, in all that political drama, when we're starting to price in the curve steepener, saying what does it mean with Trump, I looked at you and I said, Manus, This is so silly. We don't know what 2025 is going to look like. We don't even know necessarily who the Democratic candidate is going to be. How can you price in Trump now? And we just heard from Sarah Wolfe saying that for her, it's going to mean weaker growth. That's what Trump tariffs, that's what the policy is going to translate into. Therefore, you're going to have a Fed that cuts more. Whereas on the other side of things, you have this argument for Jan Hatzius that they're going to have to hike 5 more times. It is a fog for 2025. So how can you trade on anything other than economic data right now? How can you possibly trade the politics?
Maybe this bond market bifurcates itself into 2 sections. The back 6 months of this year, which will be driven by politics, tariffs, inflation, immigration, and then rolling into 2025 with a little bit more clarity around what it is. You may well have a Fed that's already engaged with 2 rate cuts under its belt. What will be the scale of the cutting in this cycle? You go back to the conversation that we had with Adam Posen from the Peterson Institute. He's talking about a mass wholesale removal of immigrants from this country, 1.5 million through to 7.5 million. That gives you super steroided stagflation, and that is not what the Fed wants to do with.
So the estimate for today, 190. Some of the calls vary widely. Goldman Sachs, 140. Citi, 155. JP Morgan, 200. And Morgan Stanley, 210, with Deutsche Bank at 225. Let's show you how the market stacks up heading into it. We've had 33 record highs for this equity market. Can today be a 34th? We're unchanged at this moment. 55.90 is where you stand on your S&P 500 futures. That might be determined by how today's jobs data comes in. Your euro versus the dollar virtually unchanged. Stability perhaps coming through from Europe, the UK, and a French election that showed the national rally with a smaller majority, not even an outright majority. Your U.S. 10-year yield, Manus has been great on this, whipped around first by the politics, now the economic data. Down another, let's call it 3 basis points. 433 is where you stand. NYMEX crude unchanged this morning. Let's get you to your lineup. Coming up, Nadia Lovell of UBS on why she's expecting mostly modest equity gains going forward. Then we'll be speaking to former Fed Governor Randy Kroszner on why he sees a slowdown coming later this year, and BlackRock's Jeff Rosenberg reacting to today's jobs data. So we begin with that. Our top story today, payrolls are due out in just under 30 minutes. Nadia Lovell of UBS saying this: economic data is pointing towards a soft landing, which we believe the Fed will get confidence to cut rates later this year. We'll remain constructive on the outlook for equities. We believe the bar is heading higher into the second quarter for earnings season. For the S&P 500, expect more modest gains from here. Nadia joins us now. Nadia, thank you for taking a break from your July 4th holiday to join us today. Okay, tell us. It's one thing to know how the data is going to come in. It's another thing to know how this equity market is going to react. Will bad news be good news for U.S. stocks?
We think so. As long as, it's shown that the economy and the job market is not, falling off a cliff. We know that the job market is the last shoe to drop if there's any significant weakness ahead. So if you can get something, slightly under 200K, I think that will be enough for the market. But I think the general sense is that we remain positive on equities. As noted, we do expect that the second half to be tougher and returns are likely to be more modest from here because the economic data has been surprising more towards the downside. And so that's something that we're continuing to watch. We do see that second quarter economic growth is pointing to below trend growth in line with sort of that Q1. So the normalization process is happening, and the same will happen in equities. What really needs to drive from here is going to be earnings that has to do the heavy lifting, given that valuation are expanded. And so we do think that, growth will continue to work, particularly quality growth. Tech and the AI trade will continue to work from here. For the market to broaden out, we need to see that the economic growth kind of accelerate from here and the Fed to cut by the time we get to September.
But what I'm understanding from you, Nadia, is we're not necessarily going to get that. But I could argue that in today's day and age, it doesn't matter. That all that matters is big cap tech and multiple expansion. Maybe you don't even need earnings to show up that strongly, just the promise of future earnings. Can that narrative continue, or will it run out of steam?
You do need earnings to show up. I mean, what's been happening in tech and the AI trend is that earnings has been showing up. That's why these companies are higher. And you see the more economically sensitive areas of the market has lagged because the growth hasn't fully showed up here. Now, is a Fed cut needed for the market to continue to hit new highs? Like, obviously, no. We've seen that this year, as you've noted early in the show, over 33 times new record high, and that's been powered by the AI trade. But in order to have a more sustained rally in the rest of the market, you do need that growth to show up to be able to drive that earnings growth and to see it broaden out, particularly to areas like small cap that are more economically sensitive and the cyclical areas of the market.
So, Nadia, good morning to you. When we look at this top end of the U.S. equity market, the Mag 7, the second half of the year for me is going to be about show and tell. It's going to be about delivery of AI, the monetization of AI. How much of that is proven to you? How important is that for you to remain fully committed to the top end and the Mag 7 in the U.S.?
Yes, that's important, but we do think that the market will be patient and give them the benefit of the doubt. We're still in the early stages of the build out of the AI foundation. And so what we've been focused on is really the enabling area of AI. So call that the semiconductors in particular. What's been happening is that you're seeing a massive amount of investment in this space. And so that AI investment cycle is really helping to shift semis from the cyclical industry, as it typically is, to more structural and secular growth. At the same time, you're also seeing a bit of a recovery in the more cyclical end markets in semis. So think about smartphones and PCs. And so this is an industry that could see 35% earnings growth next year on top of that 55% that's expected for this year. I think also, Manis, within tech, even hardware is looking to be okay. You're starting to see like that AI implementation, which again is still in the early innings, but as that build, that could drive a sort of a recovery and upgrade cycle within that areas of the market. So far this year, you've seen software lag because, again, that monetization needs to come through. But we think that that's attractive. So what we've been advising clients, because we think that this is a multi-trillion-dollar investment opportunities over the next couple of years, is to really add to the entire value stack. And I think, Manis, or tech overall, including the AI trade, when you think about it, it's like in this environment, high quality, strong balance sheet, strong free cash flow generation, and all of that is helping to, drive, secular growth. And is valuation cheap? No. But we do think that these companies, given the growth expectations and what they've been able to deliver, can grow into their valuation multiples.
I just want to get a sense from you of where you are with the consumer. We know your chief economist, Paul Donovan. We've almost immortalized this phrase, the hedonism of the U.S. consumer. But you talk about the consumer pushing back against margins, getting a little bit more stretched. If unemployment does incrementally rise, not an all-out recession, but drifts higher, consumer will become more squeezed. How do you position for that back-end squeeze?
Yeah, this is one of the reasons why we're less positive on consumer discretionary. As we know, this is an eclectic mix within that sector. So it's not necessarily that we're negative on the consumer, but more on the discretionary goods segments, as we know, remains particularly challenged, particularly the high sort of ticket items that remains challenged. And so the consumer, yes, is pulling back a bit and pushing back on price increases. We're starting to see discounting across the space. I mean, look at the fast food wars that are picking up this summer. But at the same time, the consumer is still cruising, right? They are still traveling. We're seeing, good trends in travel and leisure. So the consumer still has money to spend. They're just being a little bit more selective and looking for value within the broader economy. And that's where I think selectivity is key within consumer discretionary.
We've also just been discussing the right-hand tail risk of multiple Fed rate hikes in the event of more aggressive inflation going into 2025. It's not just one economist that's been saying that to us, but it's multiple people have come on board with this narrative that 2025 could leave the Fed's hands tied. They may have to hike rates. When you and the team stand back and talk about inflation and preparing for a higher inflation regime generally, how do you prepare for that? Is that the commodity exposure? Is that buying tips? In what way do you reflect that hedge?
Yeah, our view is that we do expect inflation to moderate. There is concerns as you go into 2025, depending on the outcome of the election and who wins. We know that former President Trump has been pointing to higher tariffs across the board. And so that has inflationary concern. But in general, we do think that inflation would moderate. But how do you think about positioning for that? One of the areas that we continue to like is more on the commodity side, especially oil in particular. We also like gold here, and we've been advising clients to add to those areas as a hedge against inflation, also in general geopolitical risk. We're not necessarily in the camp of seeing that the Fed will need to raise aggressively in sort of the face of potential inflation risk in 2025. We do think that the Fed will be on a cutting cycle by the time we get to 25. And a lot of times these things take time to work through the system. Even if in a scenario where we have a red sweep and that ultimately translates to higher tariffs, that is not going to happen overnight. It's more like a 2026, 2027 event, and less so a 2025 event. I think the concern is for 2025 is more a potential slowdown in growth and not necessarily a spike in inflation.
Yep, Sarah Wolfe saying the same thing to us, Nadia, that's going to take some time to play out for it actually to be inflationary. Nadia, we appreciate it. Enjoy your weekend. Nadia Lovell of UBS. Your equity market this morning basically flat, unchanged on S&P 500 futures. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahaira Yaquez. Hi, Yahaira.
Hi, Danny. Gold is headed for back-to-back weekly gains on expectations that the Fed will trim interest rates before year end. Spot gold traded above $2,363 an ounce. That comes after rising by more than 1% this week. Silver getting a boost from the upswing, advancing back toward $31 an ounce. Meanwhile, in the UK, Rishi Sunak saying he will resign as leader of the Conservative Party once succession arrangements have been made. This after he stepped down as prime minister following his party's crushing defeat in elections. Sunak saying, quote, "I am sorry. The British people have delivered a sobering verdict. I take responsibility for the loss." The outgoing prime minister congratulated Keir Starmer on Labour's landslide victory. This year's NATO summit begins Tuesday as the alliance marks its 75th birthday. Western leaders will gather in Washington, D.C. as they contend with geopolitical issues, plus major elections. U.S. President Joe Biden is at an inflection point following his disastrous debate performance, while French President Emmanuel Macron will just be emerging after a decisive second round of national voting. And Keir Starmer, whose Labour Party has just swept UK elections, as we mentioned, will have an opportunity to reset Britain's special relationship with the U.S. The summit wraps up Thursday. That's your Bloomberg Brief. Danny?
Yahaira, thanks. A week and a weekend heavy in politics. Up next, counting you down to the June payrolls report, former Fed Governor Randy Kroszner joins us here on Bloomberg Surveillance. Less than 15 minutes until jobs data hits the tape. Here's how things stack up in the meantime. We're coming off record highs for this equity market. Can it continue? It is slightly weaker for your S&P 500 futures this morning. Euro showing some strength after some stability in Europe after UK elections and another round of French elections to come this weekend. Your 10-year yield down by, let's call it 3 basis points. 432 is where we stand. NYMEX crude little changed at $83 a barrel. Your payrolls report just moments away. The median estimate in our survey calls for 190,000 jobs added in June. Unemployment expected to hold steady at 4%. The lowest call is from Goldman Sachs at 140,000. Former Fed Governor Randy Kroszner joins us now. Randy, what are you going to be focusing on for this payrolls report?
Well, certainly the overall numbers, the unemployment rate, but in particular wage growth, because I think the Fed has made it really clear that until they're confident that inflation is going to be coming down in a sustained and systematic way, they ain't cutting rates. And if wage growth continues to be around 4% or kicks up a little bit, it's going to be really difficult for the Fed to move inflation down to its 2% target.
Randy, good morning. Good to see you. Mary Daly says we're nearer to the point of where a benign outcome could be less likely. So in her eyes, we're at some kind of an inflection point. Do you think we're at a tipping point? Do you think we're moving beyond benign, where it could become a little bit more malignant?
Well, I think she's exactly right that the way that I think about the Fed's sort of risk management is that they're, I think, much more willing to take the risk that they keep interest rates too high for too long to make sure they bring inflation down, which could mean that there would be a slowdown in the labor market and a slowdown in the overall economy, rather than risk declaring all clear, cutting rates, and then getting back into the difficult situation in the late 70s, early 80s, where they called it too early, and then interest rates had to zoom up to double-digit levels.
Then do you support their prudence? Do you think that they are right to be err on the side of extreme caution rather than, roll the dice?
Well, they certainly shouldn't be rolling the dice. So extreme caution, maybe not, but caution, I think, makes sense. The costs were enormous back in the late 70s, early 80s, the last time inflation had gotten this high, and they don't want to get into that situation again. A lot of uncertainty about whether the economy is going to continue to power on or not. I think there's a reasonable likelihood of a substantial slowdown towards the end of the year. We've finally had interest rates go, real interest rates, that is the inflation-adjusted interest rate, finally go positive, but only about a year ago. With the classic long and variable lags that monetary policy has, we're going to start seeing that probably in the next quarter or so. And obviously, that's why the numbers today are very important.
Well, Randy, someone like Neil Dutta or Mohamed El-Erian would argue that the real caution should be that they need to cut rates, that unemployment rarely moves in a linear fashion. And if they wait too long, and perhaps they already have, that is what indeed we're going to see. So why should the bias be with a high bar to cut rates? Why not go ahead and cut rates if we are starting to see some inkling of a sort of slowdown?
Well, I mean, people have been looking for that inkling of a slowdown for a bit, and so have I. The labor market has continued to be reasonably robust. The overall economy has continued to be reasonably robust here in the U.S. And so I understand their caution. I would be leaning towards looking very carefully to, especially in these numbers and then in the next month's numbers, to think about whether September would be the time for starting to cut. But I don't think the labor market has softened sufficiently to say, it's obviously they should be doing it.
I think it's so fascinating because you can look at so many different things, Randy, and build your own narrative and decide what you want. I mean, America's kind of strange in that we have the burden of just too much data. It is a good thing to some degree, but you can just look at anecdotal evidence coming in. You have two luxury firepowers coming together, merging, Saks Fifth Ave, and at the same time Neiman Marcus, because they're worried about a slowdown in luxury spending. Yet at the same time, you have record numbers of people traveling this weekend who are willing to pay up for that. What becomes your guiding North Star at a time when the data often is in opposition to itself?
No, exactly. And that's why it's easy for pundits to say, it's obvious that they should have done this or should have done that. But exactly what you're saying, the data are not painting a very clear picture. Sometimes they do, but generally it's this sort of very complex mosaic where you're trying to put all the pieces together, and sometimes you build sort of a pretty picture out of it. Sometimes it's a little more like a Picasso, where it's kind of hard to know where the different parts of the image are. So I think that's why I have sympathy for them being cautious, because I think there are very high costs to declaring all clear when they shouldn't. And so as the data become a little bit clearer, hopefully we'll get some clarity here at the numbers in 10 minutes or so. And then they can make some clearer judgments. But right now I can understand why they're going to be hanging tough.
Randy, let's push a little bit more on the lever. You said there is a risk of a substantial slowdown. Randy, it is not 1999, so everybody tells me. Tech is in a different space. It is not, thank goodness, 2008, so everybody tells me. A regional bank crisis was but a mere bagatelle. So the scale of the slowdown, I'm curious to contextualize that, because that is what will define the scale of the cutting in this next cycle. So what does substantial mean?
So I think we'll see the unemployment rate move above 4%. I agree that I think it's hard for the Fed to have this, the Fed doesn't have this exact control. Some people think that, the Fed is so powerful. If they want the unemployment rate to move to 4.2% and stay there, they can make that happen. They have some levers that move in that direction, but to really nail that, there's so many other things that are going on. I mean, think of all the geopolitical risks and all of those shocks. I think those are more likely to be negative than positive over the coming year. I think there's still a broad feeling of uncertainty that's out there with the consumer, so it may not take much for the consumer to pull back.
Okay, Randy, stay with us. We're going to revisit you once we have those job numbers in hand and get your take. Randy Kroszner there. Joining us now is Michael McKee, Bloomberg economics and policy correspondent. Mike, because John isn't here, I have to start with this. Is this No Tie Friday?
It's No Tie Friday.
Okay.
John and Mohammed El-Arian and Rick Reeder and the usual gang on Jobs Fridays all agreed that this would be the No Tie Friday.
Okay, give us what signal is this giving, Mike? What are you expecting from the jobs data? What are you looking out for?
Well, I'm looking for a surprise. You go back to what happened last month, and this has happened in a number of different months, and we had 180,000 was the consensus forecast of economists. The whisper number was even worse. People thought we'd get 168,000, and instead we got 272,000. Like, where did that come from, and why did we miss so much? So do we get a surprise like that again this time? The forecast is for 190, pretty much the same as it was last time. Whisper number, 185, looking for a smaller than the economist's number. So what does the actual come out to be? And then, of course, if the unemployment rate should rise a lot, you'd have to go to about 4.4%. Then you get the Somme rule triggered, and then you get a real freak out on Wall Street, I think.
Yep, exactly, Mike. Stay close with us. We're going to go over the jobs number with you. And Manis, it is this curiosity of, if we get a surprise, where does it come from, and what do you care about more? Wages, payrolls themselves, or unemployment?
Well, the Fed seems to be tilting away from inflation. These reports do matter ever so much more now. It is about the scale of slowdown that is going to come. And if it comes in at 190 or less, it's certainly going to be good news for the bond bulls out there.
Yeah, but what do you do if it's hot wages? There are still surprises that might be in the... Good. Well, we're here together to panic on this July 5th after your July 4th holiday. So coming up next, we're going to have that June payrolls report for you. BlackRock's Jeff Rosenberg will be here with us to react. We're going to also revisit Randy Kroszner as we debate. Your estimate is 190. The lowest is Goldman at 140. RBC has the highest at 237. Just minutes away on Bloomberg Surveillance. It is seconds until your jobs data. Here's how the market stacks up this morning. Your S&P 500 futures basically unchanged, 0.04% higher. NASDAQ takes the reins as Russell 2000 falls. Let's get a check on your bond market this morning. We are buying bonds ahead of the print, down by 3 basis points for your 2-year yield. 431 is where we stand on your 10-year yield. 449 on your 30-year yield. The data starting to come in now. Mike McKee joins us now. What do we got, Mike?
Well, we've got the drama you were just talking about as you set us up for this. 206,000 jobs created in the month of June. That is much higher than the 190 anticipated. We talked just before the data came out about potential surprises. The unemployment rate is another surprise. It rises to 4.1% from 4%. The forecast was only for 4%. So we've got a difference there. Interesting number for the 2-month net payroll revision. We'll see which months it came out in, but down 111,000. So on the one hand, we get stronger growth in this month, and the 2 prior months, we get a significant drop there. So you put it together, you probably have a slowing economy story. 0.3 for average hourly earnings as forecast, 3.9% on a year-over-year basis. No change in hours worked, 34.3. The labor force participation rate, 62.6, goes up from the prior month, and 7.4% for the U6 number, the underemployment number, as they like to call it. Let me just take a very quick look here at the number of people who were reported hired in the household survey, 116,000 plus. So it's lower than the establishment survey, but we don't have that big gap that we saw last month.
All right, Mike, I'll leave you to look through that a little bit more. Let me show you how these markets are stacking up. It is that unemployment number at 4.1% and the revisions that we appear to be trading on. It is a rally that is thin and it is fragile. We are going back and forth. At one point, it was small caps up precipitously. We're up now just 0.2% for both the NASDAQ and the Russell, having a hard time of what to make of this. In the bond market, the direction is perhaps more clear. It is a bond market where yields are falling over that concern that Mike was talking about, over the concern of economic weakness. If we have unemployment at 4.1%, yields down 6 basis points, more than 6 basis points for your 10-year yield. 4.29 is where we stand. For your U.S. 30-year yields, we're at 4.47, a move of 5.5 basis points. So, Mike, this is a market that's treating this like an economic slowdown. Stocks are unsure of what to make of it. But is that fair, that this is a bond market that looks at unemployment at 4.1% and says, oh, no, the Fed needs to cut?
Well, the Fed has a reaction function for this. The markets have an overreaction function for this. The narrative is going to be that this is a sign of a slowing economy. We saw this big revision down in the April and May numbers. April revised down by 57,000. May revised down by 54,000. Very significant numbers. So the overall pace of job creation has slowed, even though this month is higher at 206. There's a good chance it'll be revised down as well. And now unemployment climbing a little bit faster than the Fed expected. They said we would be at 4.1% at the end of the year. We're at 4.1% now. Not triggering the SOM rule, but it does show a slowdown. And then that becomes the question that the Fed has to decide as they try to put together the Picasso that that Randy Kroszner was talking about. Is this the slowdown they wanted, or is this a sign that the economy is in trouble? And I think on a slow trading day with not a lot of volume, it's gonna look more like a panic type situation, slowdown. But overall, it just kind of gives you the impression that we are where the Fed sort of expected to be.
Is this going to endorse the Mary Daly view, the Powell view that we heard from him in Sintra in Portugal at the start of the week, which was talking about things are finely balanced now? These kind of revisions, these are not insignificant revisions, 111,000 in both April and in May. So you think this tilts towards that sort of tipping point in the jobs market? Randy Kroszner described it as he's expecting a substantial slowdown. Is this the foothills of substantial slowdown?
Well, that's what we have to find out, because you would say that if the number was weaker this month than it is.
Right.
But at 206, that's a kind of a rebound from what happened the two prior months. Now, does that get revised down? Fed's going to have to look at that when we get the July payroll numbers at the beginning of August. They won't have them for the next meeting, which nobody expects them to move anyway. But it is going to be a conundrum for them. I'd say it underlines what Daly and Powell were saying, that they got to keep an eye on this.
And again, I find it really interesting. For the second running month, we have this tension between the headline number and a higher unemployment rate, 4.1%. Again, if you're just joining us now, that's where it came in. For the jobs data itself, 206,000. The estimate was for 190,000. Mike, you're going to stay close with us. Keep digging through those numbers and see what you can see. Joining us now is BlackRock's Jeff Rosenberg, and former Fed Governor Randy Kroszner is still with us. Jeff, let me start with you. What's your first take on these figures?
My first take was your first take, that it's the revisions and a little bit the unemployment rate figure that the markets are most focused on here today. Look, I think this is supportive to the story of slowdown in the labor markets that Powell is looking for. I think you see that in the bond market reaction. And I think this keeps September on the table. I think the other story here, and why the market reaction to the revisions, is there's a bigger story that there's more Manis, that is a beautiful turn of phrase, the foothills of substantial revisions. I think there's a big story there in the market that there are revisions coming, that the establishment's survey is overstated. You do get the benchmark revisions, and there's an expectation here that you're seeing an overstatement, and that is a little bit fed into the market narrative with the 2-month revision number that you highlighted earlier.
Randy, would you agree with that? Some slowness in these numbers, a slowdown potentially confirmed?
I wouldn't say it's confirmed. I mean, obviously, that was something that I'm looking for. I think, as we were describing before, and as Mike picked up on, we've got the different pieces of the Picasso, and it's hard to put the image together right now. And I think this is very much consistent with the Fed's focus and Jay's focus on the labor market, watching it very carefully. This is really consistent. This is broadly consistent with kind of the slow cooling of the labor market that they want. But I think it's going to be difficult to just say, we can stop the cooling whenever we want with just with a couple of rate cuts, because of the long and variable lags. It's going to be hard to do that just at the right time. And so I think, just as Jeff said, the Fed's not going to move at the end of this month. But September is live, because we'll see how the labor market. They'll get a couple more labor market reports before that meeting, and I think that'll be really a key thing. But the wage inflation has not come down. It's basically in the same range that they were expecting it to be. So if that drops significantly, that would give them the okay to go ahead. Now they're going to be cautious.
Is this, Randy, good morning to you. Jeff, good to see you. Randy, is this going to come down to the part of the curve where the jobs are lost? In other words, forgive me for being so brutal, but the quality of jobs that are lost in this next unemployment cycle, that's going to be critically important here, isn't it?
Well, they'll certainly be looking at the types of jobs, because obviously, depending on whether you lose jobs at the higher pay or lower pay, that's going to affect the average wage, the so-called composition effect. They'll be looking at that. They'll be looking at potential pockets of weakness in certain areas that may be more interest rate sensitive. And so they will be looking not just at the overall numbers, but kind of digging deep into where they see monetary policy having an effect.
Well, when you look deep into those numbers, Jeff, let me bring you back into this, because you mentioned this, a wages growth, 0.3%. There is still growth here. You could even look at the weak ISM services number that we got earlier in the week, and still prices paid are higher. If I wanted to make an argument for why the Fed should hold, I could make an argument about this, that, look, wages and prices are still high. It is too soon to move. Is it an error to err on that side, to say, look, we need to continue to hold where things are until some of those factors start to come back in line?
You're pointing out the part of the labor markets that has been the least that has shown the least progress in terms of showing the normalization. So whether it's AHE wages that we're seeing today, ECI, Atlanta Fed Wage Tracker, our own private estimates through scraping jobs posting data, they all point to a similar story, which is the pace of slowdown and the pace of normalization hasn't really kept up. We've kind of normalized to a pre-COVID tight level of labor market conditions and elevated wages relative to productivity. So that's the one thing that kind of keeps the Fed a little bit at worry in terms of moving too quickly. But it's the broader price data we'll get next week that is really going to be more determinant. I think they'll be okay with wages stabilizing, and as long as you're seeing the broader wage pressures continue to normalize, and certainly not a repeat of what we got in the first 3 months of this year of a reacceleration, that's going to be the backdrop for the Fed to open up the door towards slow normalization, maybe quarterly pace of 25 basis point cuts.
Again, for those just joining us this morning, we just moments ago got the jobs figures. 206,000 is where we landed. The estimate was for 190. Also a revision for April and May, down by 111,000. Unemployment rate goes from 4% to 4.1%. Mike McKee is still with us, digging through the numbers. Mike, what's some of the other takeaways you're seeing here?
Well, there's a lot in here that addresses the idea of how serious a slowdown this is, and it might have a bearing on inflation as well. First of all, the unemployment rate, it goes up because we saw a large rise in the labor force, 277,000. Now, what's interesting is that we have seen a decline in immigration. People have been giving immigration a lot of credit for the jobs numbers. And in this case, it didn't translate. The decline didn't translate into fewer people coming into the labor force. But it only pushed up the unemployment rate by a little bit. It was 4.054 when you take it out to three digits. So just barely rounding up to 4.1%. And you look at the number of people who lost jobs and got jobs in the household survey, employment and unemployment, they're almost exactly the same, 116,000, 168,000. What really stands out is very weak performance for service-providing industries and manufacturing. Manufacturing lost 8,000, construction gained 27,000, but for service industries, only 117,000 jobs created, and most of that was in the healthcare field that we normally see adding a lot of jobs. Instead, the big number is government, 70,000. And so the loss of service sector jobs suggests that maybe we'll see some inflation come down in the service industries because labor costs are the biggest issue there. And it also may mean that the government hiring may be a seasonal adjustment problem, and it could end up being revised lower. So at this point, it's definitely, as Randy said, kind of a Picasso here. A lot of different things in here that tell you the economy has slowed, but where we go from here is going to be the interesting question.
I think there's a couple of other numbers that are coming through on the T-Lab that various colleagues are pointing out. Temporary help is down a massive 48,900 in June. That is the most since 2021. And the time that it takes you to get a job, the median time that it takes to get a job has gone to 9.8 weeks. And that's up from 8.9 weeks. Now, look, these are idiosyncratic in those revisions. The powerful message is going to be in the revisions, and it's going to be in the unemployment numbers. But that temporary help, that's quite a flashing amber number, especially given services dropping so significantly to a 4-year low going into this.
Well, temporary help is usually sort of thought of as a sort of canary in the coal mine, because if you're going to be adding workers, you go to temporary workers first. In this case, that doesn't seem to be the case. The interesting counterpoint to that is average weekly hours didn't change, and you would expect that to start to go down if companies were seeing business slow. So that's something to keep an eye on. We did have a pretty good idea about taking longer to get a job because the continuing claims numbers have been going up.
9 weeks of gains,
Yeah, that's what it's been telling us. But it is interesting to see that maybe this canary just sort of cheaping a little bit here.
Just a slight tweak coming from the canary. Jeff, I want to bring you back into the conversation. BlackRock's Jeff Rosenberg is still with us. Jeff, I want to touch on what Mike was talking about, of particularly the services sector being weak. This is the part of inflation that we had been worried about service inflation not coming back in. If you look at the contours of this report, does it give us more confidence? Is it enough to cement September for the Fed?
Probably not quite enough to cement September. When you look at the services, it's what the conversation was just on. It's that big drop in temp help, minus 49. The 3-month average, it's just a little bit below that. So it is one of the highlights. There's some other industry highlights there. You got a kind of a big offset in government that Mike talked about. So there's some cross currents there. There's a pretty strong construction number that could be seasonal, that could be weather affected. And the seasonals that Mike mentioned are particularly tricky, especially around the government data, given the education flows in and out. So there are some cross currents that make it a little bit tricky, and I think when you're looking at those details, it's hard to say that cements it. I think what will cement September is really another round of data, and more importantly, what we see in terms of the inflation data next week and what we see next month. I think that's going to be the case. As long as we're seeing trends towards slowdown in top line, the unemployment rate, broader measures of labor markets normalizing, I think that'll be enough. Not enough to say that today, but I think once we get to September, that'll be there. And obviously, as Powell has said, any surprise slowdown, acceleration, the earlier conversation around perhaps there is a bigger revisions and benchmark revision that tells us that establishments as a survey has been much more overstated. Perhaps if that comes through, that's the cement in an environment where inflation is continuing to deliver this kind of pace towards 2% that Powell and the Fed have talked about. A little bit too early to say that that's the read today, but as you can see, and you got up on the screen, the yield reactions are moving towards raising that probability of a move in September.
So, Jeff, tell me this. We had Priya Misra with us a little bit earlier on talking about the reinvigoration, the reincarnation of the Fed. But that is certainly there. When you look at the market reaction function today, yields are lower. Again, the bond bulls have been handed a fig leaf to reinvigorate their bullishness because they've been slapped by politics in the previous week. Does it embolden you in regards to duration? And does it cause you to be a little bit more anxious about credit?
So I would say on the kind of the Fed put, it is a big deal. And while we're talking about policy, what we haven't really spent a lot of time talking about, and we haven't really heard what I mean by that is the FOMC and the Fed and Powell, is talking about the impact of financial conditions. And so the proposal, the way in which the Fed has been treating its response function to inflation. If inflation surprises a little bit stronger, they'll hold rates here. If inflation returns to trend, they're excited to cut rates. It's an asymmetric response function, but it's very market friendly. And it's what perhaps Priya and you were talking about earlier, brings back a bit of the Fed put. That's led to much easier financial conditions. And when you look at financial conditions relative to interest rates, what you see is a huge disconnect, that policy is much easier than what the interest rate would otherwise imply. So yes, that's good for risk taking. Does it embolden duration? I think you got to be careful when you talk about duration in a portfolio about where you hold that duration in terms of maturity. You mentioned earlier this week, we saw a big bear steepening. We've got fiscal policy challenges in the back end. And so I think it emboldens the part of duration that the Fed has its greatest influence over, and that's the front end of the curve, and maybe moving out into the front belly of the curve, kind of the 2 to 5 year part of the curve. But I think the back end of the curve, in that kind of traditional way in which people have thought about using the longest end of duration as its portfolio hedge, I think we have to really rethink that in an environment of substantial changes to fiscal policy.
And that substantial change in fiscal policy, even if it is Biden or another Democrat in the White House, there will still be a continuation of some of the Trump tax cuts. And if it is Trump and a Republican sweep, then the coupon sizes are going to rise. And the theory of the policy that he espouses at the moment is, for some, very inflationary. So is it next year that the bond market is really tested in terms of its appetite to take inventory on?
Yeah, part of it is the pressure between kind of Treasury and the Fed, how much Treasury has been able to hold the coupon issuance back from the bond market by keeping these bills issuance high. And so that time period of when that starts to really be impacted in the back end of the curve, one, it's a function of the expected path of fiscal policy. Two, it's a function of the Treasury issuance pattern. And three, it'll be a function of where the demand falls in terms of global investors, and more importantly, global private investors, because that's the other piece of what is substantially different here, exiting the era of QE into an era of QT. Yes, I know we're normalizing that as well. But there's more reliance on the private markets to fund those increasing debt and deficits. And I think when that starts to hit, and we saw this last year a little bit, is in the quarterly refunding announcements. And when you get that change in that coupon issuance that we know under current trajectories is eventually going to happen.
Okay, well, a lot of nervousness going into next year as well, isn't it, in terms of the size there? Jeff Rosenberg with the very latest on his first take on those jobs. Danny gets a short reprieve from Jobs Day Friday. She's going to turn up in the 9 a.m. show. There's no rest for the wicked.
No rest. Before I go, I just want to give a shout out to David Kelly from JP Morgan, just barely off the jobs number. His estimate was for 202,000. I think we should give that a little bit of credence in a jobs data that's increasingly hard to call with each month.
Send him a donut. By all accounts, there's a tray of donuts out there for everybody that survived this jobs report. Without your usual team, but it's from Danny and myself. Danny will appear in the 9 a.m. She's going to take you through that market open in terms of how those equity markets react. Joining me now is Ira Jersey and Michael Casper of Bloomberg Intelligence. Ira, to you first of all, good to see you. The bond market genuflects nicely, 2 revisions. Despite the 206,000, 2 revisions coming through in May and April. Yields drop, the bulls are emboldened. Good morning.
Hey, good morning. Yeah, that's exactly what's happened here a little bit. You've had a little bit of a rally in the bond market just on the back of those revisions, and also the slightly higher unemployment rate, I think, is, that's a headline grabbing kind of thing. Although, as Mike McKee mentioned earlier, it was incredibly small. It was all about rounding, quite frankly, to get us to that 4.1. The bond market's thinking that the Fed is going to cut this year. The question is by how much. And importantly, and what I've been focused on and looking at is what's happened for next year. So the market has basically priced in another half a interest rate cut for 2025. So you see things like 2025 Fed funds and SOFR futures. That's where most of the rally, that's where the biggest rally in the market has come from, and that's why you see 2-year notes better by about 7 basis points today.
Okay, let's bring Casper into the conversation. So, a little bit of a revision in the slowdown. I mean, more than a little bit, 111,000 on each. That raises the possibility of another revision to this number when it comes through. But the question is, unemployment rising to 4.1%, the numbers in of themselves, the revision, also a little bit on the shaky ground. Does it cement 50 basis points for 2025?
I don't know if it cements
2024, excuse me.
I don't know if it cements it, but it certainly makes it a little bit more likely. And the way we're watching this for equities is that there's a few ways. First of all, on the unemployment side, that's typically a good indicator of forward earnings growth for the S&P 500. So with unemployment rising a little bit more than estimated, possibly a little slower earnings growth on that side. Just to keep in mind, though, bottoms-up consensus, so the stock consensus is about for 13% EPS growth over the year ahead. If you put that into our model, which does include unemployment rate as one of the factors, that's down to 5.5%. But on the other side is the rate side, which you're talking about. And if it does cement 50 basis points, it does give us a little bit more leeway with the multiple. So in a way, our models are a bit self-correcting in that kind of way.
Okay, Ari, let's just bring it to you. I know that if Mohammed Al-Arian was here with Jonathan now, there'd be a haranguing and a hand-wringing going, the Fed are behind the curve, the Fed are behind the curve. I mean, again, he has always sort of accused the Fed over the past number of months of being behind. Do you think that this emboldens that narrative that they need to be a little bit more forward-thinking as this small slowdown begins?
Oh, I don't think that that's the case at all. In fact, we have a chat with about 1,500 investors in it, and basically everyone's mixed. So, some people are saying that this is a clear sign that there's slowing of the economy and that the Federal Reserve will have to cut earlier, and September seems appropriate. And then some others who are noting that that the labor market still seems reasonably tight. Our work suggests that anything above 100,000 in terms of payrolls is actually not a bad number. And if you go back, we're looking at this in a microcosm of the post-COVID era. If you go back to the inter-crisis period or go back to the early 2000s or even the 90s, if you have 150 to 200,000 jobs, that's fine. That's good growth. And it's still higher than replacement. So what that means is we would still, at 150 to 175,000 jobs created, still be creating enough jobs that the unemployment rate should remain more or less stable. And that would be, that means that the Fed could probably stay on hold a little bit longer.
Ari, thank you very much. Ari Jersey, Michael, last word to you in terms of the equity narrative. As you said, self-balancing models. But the bottom line here is the consumer's going to get a little bit more squeezed again. Is that where the pressure comes in the equity complex? Outperformance at the top in the Mag 7, but you don't go for breadth yet. Briefly.
Well, breadth, we think, is going to increase with the earnings growth picture kind of evening out away from the Mag 7 towards some of the other sectors. You mentioned the consumer, though. Mm-hmm. Consumer discretionary is at the bottom of some of our sector models. It's a place that we've been seeing some issues with both valuations and earnings. So definitely towards the bottom.
Okay, thank you so much for being with us. That's our own in-house team, Michael Casper and Ira Jersey. Normal surveillance will be resumed on Monday. Be assured of that. The jobs report is very clear. 190,000 is what we were expecting. 206 is what was delivered, with significant revisions in the April and the May numbers. Unemployment rises to 4.1%. At 9:15 a.m. Eastern Time, the Open will get together with the acting Labour Secretary, Julie Su. That is it from Bloomberg Surveillance. I'll hand you across to Danny Berger to take you through the next hour. Good morning.